Let us wait for a couple of minutes. In the meantime, probably others will also join. Okay, so Vivav is there, right?
Yes, sir.
And who all are there? Sudiksha, Vivav, Vishal, Prakhar, Apur. Okay, so maybe let's wait for 2 minutes, 3 minutes more, then we will start.
So, what are the topics for today?
Okay, so today we would be doing option strategies, right? We started off with option derivative options in the last class, right? So we will build on the same thing, and we'll cover couple of strategies that we can apply and make use of the option market, and how the traders actually utilize those strategies and all that. So that is what we would be covering today. And at the same time, if there are doubts with the last class, because we need to be clear with the stuff that we have done in the previous class. Otherwise, this class is going to be difficult, because here what you're going to do is you're just going to understand the permutation combinations in the option, put, call, and all those things. The four thing that we did in the last session. what is the relevance of call, what is the relevance of put, then long call, long put, short put, all those things, the four things that we discussed in the last class. So that is what we would be applying along with the normal scenarios that we have. So that is what uh, is something that we would be doing in today's class. So if there is any doubt with the last class that we had, then probably it is the right time to clear those doubts now, rather than be confused with the other stuff that we're going to do. But even you are confused somewhere, not able to understand, don't worry. We would be having other doubt classes also, so you can certainly ask your doubts there also. It is not, you can't ask your doubts later on. The only thing is there are a lot of things that we're going to cover now, right? So, and combined with the previous syllabus, then it would be difficult to revise everything at one go. For sure, you'd realize, right? So, I would stress, like, try to understand everything at this point in time. However, if something is missed, something is not clear, then for sure, take a read, make a point of those items which you think you need to have a more refresher or more sort of a class on those items, then we can probably take those things later in the revision class or in the doubt sessions that we conduct later once the certain chapter or module is complete, right? So that is how we would be doing. So are there any doubt with the previous class that we have done? Because I understand online is at times is difficult to grasp everything that we do, because you cannot see the facial expressions and all other things, and at times also things are not that convenient for everyone. Be comfortable with technology, be maybe there are some technological challenges also. At times the voice clarity is not there, or certain things are not is not in line with the expectations, so that may be the challenge. But be it like be it the situation, will have to manage with one thing or the other. So the only thing which I want to stress upon at this point in time is this: like, try to understand as much as possible. However, if you're not clear, ask your question, and still you're not comfortable, probably make note of those questions. You can ask those questions when you think you can cover in the doubt sessions and all other sessions that we were going to have, right? So before probably we move on, uh, any question with the previous class? Anyone? What we did is the derivative forward and futures, and then we did the derivative options, right? And then we also did the evaluation of derivative, and then now we are supposed to do the strategies. So what strategies we have in the options world? So give me a second. Let me just open the PPT. So this is what we did in the last class, option Greeks. The Greeks, what the option Greeks are all about. So we should be clear with the option Greeks also, and why the Greeks are there. So Greeks are basically to have a proper valuation mechanism for options, and that is why we have option Greek there. So just to start with option Greek again, we can just probably cover it quickly and then move on to the other stuff. So we have option Greek. So these are the Greek's letter. That is why I see option Greek. So delta, gamma, theta, vega, and rho are the five Greek letters that represent different values of options. So Gamma reflects the change in delta. How delta is changed further when there is a change in the underlying asset. So there is an acceleration that is happening on delta when there is a change in the underlying asset value. So that is reflected in gamma, reflected via gamma. Then theta is called the time. So with the time uh, moving on, so the value of the option is also decreased. So that is reflected with theta. And vega reflects to volatility. So what's the volatility in the market? So that is captured by vega, and it is also called implied volatility. Rho doesn't have large impact on the option pricing, but it does have some impact. So that is called the interest part, how the interest is there in the market. So that is reflected by the rho. So let us just delve more into these in these few as in these Greeks item. So delta represents the rate of change between the option price and the dollar change in the underlying asset price. In other words, the price sensitivity of the option relative to the underlying. Delta of a call option has a range between 0 and 1, while delta of a put option has a range between 0 and -1. Right. So this is when I say 0 to 1, basically it reflects 0 to 100%. So it's in a percentage term, you can say when I take it 0 to 1, so how much positive and negative it can go in the percentage term, it is shown here. So an example, if you look at this example assumes an investor is a long on a call option with a delta of 0.50, with a delta of 0.50. Therefore if the underlying stock increases by $1, the option price would theoretically increase by 50 cents. So this is the example. With this you can understand, if there is a delta of 0.50 for a particular option, right, and if there is a $1 increase in the in a particular underlying security that on which you have got an option, so how that delta would be reflected? So that means it basically says the 50%, right? So if there is a $1 increase in the asset value, so the option price will also reflect the same. So that means the 50 cent would be added in the option pricing. So it would be 50 cents more than what the option price was earlier. So that is what is reflected with the change in the $1 increase in the underlying asset of that particular option that we are taking as an example. So that is delta, right? Then when you look at gamma, so how gamma is there, how gamma is looked at. Gamma represents the rate of change between an option's delta and the underlying asset's price. This is called second order price sensitivity. Second order price sensitivity in the sense like one is the delta, which is representing the price, right? How the price is changed. So this example gives this examples make you clear like how the value of data is captured. So if there is, assuming there is an option with which has got a delta of 0.50, that means 50% in a sense. So if there's a $1 increase in an option of the underlying asset, then there would be a 50-cent increase in the option price as well. Similarly, when you look at gamma, so gamma basically shows how the value of option price is being increased with every dollar increase in the underlying asset. So it is telling you the net effect on the option price. So it is just not about the only delta effect that is coming on the option price. There is more effect. So that effect is represented with the gamma. So gamma shows how the acceleration of delta is happening with a $1 increase, with every dollar increase, I would say. So gamma indicates the amount delta would change given a $1 move in the underlying security. So let's look at this example. For example, assume an investor is long in a call option on a hypothetical stock XYZ. The call option has a delta of this. So this is the same thing that we have done in the previous in the previous slides. So delta has, there is a delta of 50 cents, 0.50, and gamma of 0.10, right? So therefore, this if XYZ increases or decreases by $1, the call option delta would increase by 0.10, right? So that means if I just open that Excel file again, give me a second. Okay, so we were so assuming the the price of the stock, the underlying stock for an option, and we're talking about call option here, and the underlying asset is a stock, underlying asset TCS stock, right? The same example, and the price, stock price, stock current price is 2100, right? And the option price is, and assuming there's an option, you're taking an option, call option with strike 2200, right? And now, so this is the underlying stock with the current price, right? And there is a call option that you have took with a strike of 2200, right? So what is happening? So here the example that we're talking about is, if the stock value increases from 200 to 201, there should be a 50 cent increase in the option price. So the option price is the option that you bought for maybe 10,000 rupees. I'm just taking a hypothetical example here, or rather I would take in a one share price, not instead of taking the entire lot price. So there are 600 shares in a lot, multiply, let's take 10 is the option price, so 10 is the option price, right? So total is 10 into 600, that means this is the total price of the lot that you bought for a strike of 2200. So now when there is a change in the delta, as in the price in the stock, so how much there would be a price change? It would be 10.50 would be the change when it is moving from one point to another point. So that is what is reflected here. If there is a, if the delta is this much, if delta is 0.5 for a particular stock, so if there is a change in the price, if the stock is moving $1 moves, I'm taking it a dollar, not rupee. So if it is moving $1, so that means the delta would be, this is the delta, so then the stock price would be this. And now look at gamma. So this is also delta that we are talking about, right? Now the gamma says, when there is a next, when there is a next dollar change in the same security, so if it goes to 21 to 21.2 now, so it would be the same 0.5 plus 0.10 increase. So this time the increase is more than what it was. So it would be 10.5, which it was earlier, plus 0.50 plus 0.10. Right? So this is the 10.5 is the old one, the previous price. So next is your 0.50 plus 0.10. So that is how, one second. So this would be the price when there is another dollar increase. So with every dollar increase, so there would be a different change in the option price. It wouldn't be only 0.5 change every time. So it would be increase of 0.10 with every dollar increase, right? So 0.5 plus 0.10 plus 0.10. So this time it would be this. So there is an incremental, there is an incremental change happening in the option pricing. So that is reflected by gamma. And in other words, you can say the gamma is representing an acceleration on delta. So that is also what we say it is the same thing. So net effect, if you see at the price, it is going to be different. So there would be different effect on the price at the same time. So these are the two things where the option price is being increased with the help of delta and gamma, right? So we can clearly make out delta and gamma, what they are doing, they're increasing the price. What if you look at on the other side, theta is decreasing the option price, right? So that means the option price is losing its value as the time passes. Why? Because the options have a maturity of 1, 2, and 3 months. So if you bought an option for 1 month, so there would be some decrease in time. So that would also be taken into calculation while you're doing the option pricing. So it is not only one-sided increase in price would be reflected in the option price. It would also be considered the minus factor or decrease factor which is coming into the price due to the decrease in time value, right? Any question, anything not clear as of now here? I know maybe it is, these are the terms at times confusing, so don't worry, you need to read it through a couple of times, then you would be clear. So look at this, what is written here. Theta represents the rate of change between the option price and the time, or the time sorry, time sensitivity, sometimes known as the options time decay. Theta indicates the amount an options price would decrease as the time to expiration decreases, all else equal. For example, assume an investor is long on a call option with a theta of minus 0.50. The option price would decrease 50 cents every day that passes, all else being equal. So if 3 trading day pass, the options value would theoretically decrease by 1.50. Theta increases when the options are at the money and decrease when the options are in and out of money, right? So this is an example given. So with every day passed, there would be a decreasing effect in the price of an option by 0.5. So here the couple of things we have assumed. One, the value of delta is 0.5, right? And the value of theta is 0.5. And similarly for there is a acceleration is something that we have assumed. So these are the values which are calculated basis the historical data, how a particular stock or the underlying security or the particular asset that we are talking about has behaved over the years, and basis that all these values are calculated, and then it is assumed this is how the impact would be in the option price, right? So this is theta. Then come to the implied volatility, that is represented with the help of vega, represents the rate of change between options value and the underlying rates implied volatility. This is the option sensitivity to volatility. The vega indicates the amount an options price changes given a 1% change in implied volatility. For example, an option with a vega of 0.10 indicates the options value is expected to change by 10 cents if the implied volatility changes by 1%. So what this again, so if there is a change, any questions here?
So I have a doubt.
Yeah, yes, Siddharth,
Like
go
when
ahead.
when a person books an option deal, okay,
Hmm.
in what scenario will they choose this alpha, sorry, this gamma and theta and all?
Okay, very good question. So from the investor point of view, you are not going to choose all these things. So this is basically representing the mechanism which is happening behind the trade. So like if you've taken a trade, right? So
Mm-hmm.
how that price, because when I say price, if you talk about an option trade is about the premium that you receive, right? That is the
Yeah.
profit and loss. That is
Mm-hmm.
the profit and loss. So that premium which you have paid today can be
Mm-hmm.
higher tomorrow. Why? If these factors, the option Greeks have behaved in that way. So when I say the underlying asset has moved up, right?
Mm-hmm.
So maybe today you bought an option for 5 rupees.
Mm-hmm.
Just take an example. I took an option for 5 rupees for an ICC bank, right?
Mm-hmm.
And
Yes, sir.
tomorrow the same option might be 6 rupees for 6 rupees. That means there is a one rupee increase in the option price, right?
Yeah.
So why that effect has come in the option value is because there have been some changes in the delta, gamma, and theta and implied volatility. So those uh, those effects are reflected in the option pricing. So you as an individual would not be able to change all these terms. Once you have taken a position in the option, that means you have taken the position. Now you can close your position with profit or loss. These would be these would be reflected in the option pricing. So when I say option pricing, that means if there is a change in the underlying asset, so then the impact would be reflected in the value of the option. So as an example, the TCS share that we're talking about. So if TCS share stays same, right? If it stays same means if you bought it at you took an option contract for a strike of 2200. So you expected as an investor the option may go beyond 2200, right? This was the initial premise on which you bought this option contract, and we assume the option this particular option does not move at all. It stays at the 2100 only, or maybe it goes below. So then the price of the option, which was 10, on which you bought on one particular day, maybe let's make a date also, on 5th December, right? Now this is going to expire in 30 days time, right?
Yes.
30 days time. So with every day passing, there is a change in the as in the option price. So how the change is going to happen? This 0.5 will any which ways kill your option price, right? The 0.5 is the value of the option. So there is an increase, assuming the increase is 2101. So there is an increase of 0.5, assuming the delta is 0.5. So this is something assumption that we have made. The 0.5 assumption that we have taken for a delta value has actually been calculated by the historical data, as in how this particular stock has behaved and how the this pricing as in for a particular stock has been made over the years, or with the previous data, historical data, you can say. So one side you are increasing the price, at the same side you will have to decrease the price also, because we know there is a time decay. You are going to lose every day. So this 0.5 increase and 0.5 decrease also. But if a stock goes up, and assume now it does not move up, so your option value will automatically go down, and at the end of the maturity it will be zero, because this price that you have paid has paid at one point in time, and now you waited for 30 days, you waited for this price to move up. It moved. When it moved, then your option that the price also reflected in the option pricing, as in it moved also. But if it did not move to your expectation, right, at one point in time it will come to zero. It will become zero. It is supposed to become zero, right? Why? Because you have bought a deal for a number of days. So that means within that number of days something happens, and the option price will remain, or will go beyond what you bought it. Or if it doesn't happen that way, then the option pricing will be zero at maturity or at expiry. So that is, the longer the expiry, so better the option pricing would be there. And all those factors, volatility will add into the option pricing, and therefore the option pricing will stay intact for long time, or it would be on the higher side if the time duration or the time value is there. So maybe you get the point what I'm trying to convey here. So like how this is actually coming into play. It is not something with the investor's hand, like how the investors can actually play with this thing. Investors can only take a position, but this is just reflected if you would be able to make a profit or not. So if there is no movement in the stock, assuming there is no movement, it stays on 2100. When you bought this option price, you bought it at 10, it doesn't move from 21 to 2100. That means you are not going to make any money, rather it would be losing its value, because time decay is already happening. So time decay will kill the value of the option, and at one point in time the value will become 0. However, if it keeps on moving, the option price will also move, but it has to move with a speed so that its value remain meaningful. Why? Because you have taken a strike of 2200. So any which way, if it doesn't touch 2200, this value, this option price value would not be making any, would not be, as in the option would, this option which you have bought would not be meaningful for you. Why? Because at one point in time, this option has to expire. So that point in time, it will lose its entire value, right? So if it is nearing the strike, maybe assuming nearing the strike, when I say, if it reaches 2180, right?
Okay.
After certain days, it reaches 2180, and now you have only left 5 days for expiry. There are 5 days left for expiry. Then also it will be having its value. It will be having, so same thing would be applied here. It will be calculated with the same thing that we have just seen in the slides. So it would be still having value because it can touch 2200, and when it touches 2200, from there onward, the you actually start making profit, right? So if the number of days are less and option is not closing to the strike, then the option would not be maintaining its value, or it would be losing its value for sure. However, if it is nearing the strike value, strike price, and the number of days are also more, then it is for sure going to give you more price, better price. And how do you make profit? So if it is 10, you bought it at 10, and if it becomes 11, that means you made a profit of 1, right? 1 into 600, that means you made 600 rupees. 1 into 600, because there is a lot of 600 shares if you talk about TCS one. So you have made a profit of 600 rupees in a day itself.
So
So
in
that
one,
is how. Yeah, yeah, go ahead, Siddharth.
yeah, so in one option, all these are implied, like delta, gamma, and vega. Everything is implied.
Right. In one option contract, so that you buy, so all these terms are applied, and basis the terms, the value of the option is calculated. The option
Okay.
value that we say, this value, the 10 rupees value that we're talking here, is actually calculated basis the factors that we're discussing: delta, gamma,
Mhm.
theta, vega, and rho. So these are the 5 Greek letters that we have, there, and these letters actually represent the behavior of of the things, how the option price is actually calculated. So hope some clue, some idea there.
Yeah, yes, sir.
Yes, sir, got it.
Great.
In everything,
Okay, so yeah,
so in every given option, all these that are implied, right? This
in every
delta.
option,
Okay.
in every option that you talk, all these things would be applicable.
Okay. Sir.
Means
Thank you.
means in every option there is 5 features which is called Greek. Like 5 features are theta, delta, gamma, rho, and other. These are the features of an option.
Right. You can absolutely say that way, because these are the terms which are driving the option price. So these are the features of an option, and so these are going to impact the value of the option in a sense. Okay. So let us move on. So implied volatility is done. Now the next thing is the row. So row is not having that huge impact on the option price, to be very frank, but it does have some impact. So row represents the rate of change between the option's value and the 1% change in the interest rate. So if there is a change in the interest rate in the market, the prevailing rate, then the option value also changes, right? So that is what is represented in the form of row. So this measures the sensitivity to the interest rate. For example, assume a call option has a row of 0.05. So, and a price of 1.25. If the interest rate rise by 1%, the value of the call option would increase by this much, all else being equal. So that is just it has been showed how the impact of interest rate would be there on the row, but in the technical terms it is not having that huge impact, but in theoretical sense there is an impact if there is a change in the interest rate in the market. So there would be some impact in the option value also. So the option body value would also be changed slightly. So that is how it is shown there with an example. So that this is all the Greeks that we have, and these Greeks are actually deriving the value of an option, right? Let's now move on to, okay, now look at, let me just increase the size of this slide. Okay, I think Vishal is not having, he's having some issue with audio. Maybe I'm not audible to all. I would like to ask if there is any ideal theta ratio or change. So okay, so when you say the ideal theta ratio, you basically saying the time decay, you're saying? Yeah. So ideal theta ratio is if it is to the downside, as in we have taken example of 0.5, that is quite big in a sense. So it is quite big number, right? So if it is minimum 0.10, then I would say it is an ideal. So time decay is less, and but time decay would actually be increased with the days increasing. So the time decay is not as in it is not it would not happen, it would ultimately happen, right? The time decay factor can only be less when you have a longer maturity, or there is a longer time horizon is there, then the time decay would be less. Otherwise the time decay would slowly and gradually kill the option price. If the delta has a range of 0 to 1, does theta also has a similar range? Yes,
Means,
yes, it does have.
sir, means time decay will be highest on the opening day of a contract. Opening day
Sir,
of a
am I
option.
audible now?
Yeah, Vishal, go ahead. Yeah.
Sorry to disturb, sir. I was
No
just
worries.
asking, sir, like the delta has a range of 0 to 1. Does theta
Yeah.
also has similar range, or what is a favorable number? Like if the theta is -10, then is it favorable, or if the theta is -1, the higher one is favorable for us or the lower one? The option chain has
Okay.
a as we see the option chain, there is an option with a theta of -10 for the same
Yeah.
expiry, and
Hmm.
also an option with a theta of -1.
Hmm.
So my question is, which one is favorable for us?
So yeah, so favorable is the one wherein it is to the high side, right? So that
That
means, so it is reducing your
means
less
-10.
negative. Yeah, higher the negative, so it would be more favorable for the, as in the time decay factor. It would not be killing more value if it is more negative. So in that sense, it would be
So
good
for
for the
example,
option.
for example, if option price for an option is 100 rupees,
Hmm.
and the theta is -10. So is it calculated on a daily basis, or is it calculated like delta on a per second basis?
Delta is calculated on the dollar change of
So
your
yeah,
amount.
I'm asking about theta. Delta, I get it. It is changed to every second. The theta is changed every second, or changes daily, because time
So it is
decay.
it is it is it is technically it is with the time. So if you see, it is on a daily basis. It's on daily, not on daily basis though. It is on a time basis, on a base, like the time hour and all. So that is how it is calculated. But it is not going to have a huge impact if you look at the value of a theta for a day, or then maybe after a couple of hours, the same day there wouldn't be a huge difference. But it is theoretically it is with the time, with every time it moves, the theta value also changes. But in a larger sense we look at, then theta is not going to change hugely in, but technically yes, it is on a every hour, it is, or rather with every passing minute the theta value is accounted.
Okay.
That is how this is looked at if you look at in larger sense.
Yes, yes.
But if we, yeah, because that is the time, basically means every second that you move, that actually reflects in the option price. So if you say,
Yes.
especially when you look at the last day option contracts, last day one, you will
Yes.
see there's a very rapid change in the option price. There's a very rapid
Yes.
change. So something that you bought in the morning, and in the afternoon there would be a huge change in the option price. So that would be all, because
Yes.
it is going to expire, right? It is just going to
Yes, sir.
expire, so that value would not be having any significant that point in time. So that in a technical sense, I would say it would be reflected with every passing minute or every passing second. But if you look at from the point of view of an option buyer who has bought an option a month ago, right? Or maybe
Yes.
you are sitting on the first day of the month, so that impact would not be reflected within an hour. So in every hour you would not be able to feel that change. The change you would not be able to feel if, assuming all other factors are constant, right? So stock price remains same, your gamma delta is not impacting, so you would not be able to feel that change which is happening in the time value. But
Yes.
when you move on, as in with passing days, then that time, where time decrease factor will actually be okay. Okay, so no problem, Mank. Fine. So this is this is how it happens. Now everyone is there, I guess. No. Okay. So Vishal, making sense?
Yes, sir. Clear.
Okay.
Thank you.
Any other question, guys?
Through the from the initial phase, there will be delta that would be implied, right? And the last would be vega, I guess.
No. These factors will be going simultaneously. It wouldn't
Okay.
be like one factor would be just would be moving and the other would remain silent. No, it is not like that. Every factor would be having its own role to play when the option is bought or sold, right? So every factor would be played, but the effect of these factors would be differently marked when the option is bought. So the time value factor wouldn't be hugely impacting to the option
Mhm.
price in the initial phase, right?
Oh,
But as
okay.
the time passes on, as the
Mhm.
time moves on, that then it is going to impact hugely to the option pricing. So as the
Oh, okay.
example that we discussed, when you buy an option at the last day or maybe a few days remaining to the option expiry, then you will realize, like with the, maybe you bought an option 4 days before the maturity or expiry,
Mhm.
rather I would say, maybe on Friday, and Thursday is the maturity. We know third Thursday is the maturity for an option contract. The Friday, so there are a couple of days left, so the option price would be different, and when it actually comes closer to the maturity a day earlier or day before the expiry, you will realize the value has substantially gone down. That
Okay.
is because the time value has killed it,
Okay.
right? Right. Okay.
So why don't you show a live chart of this option to everyone? They'll get it very easily
Are you
if
saying
you
from the
have it
NSE website would not be, I guess,
from the
on the yesterday's one that we were doing? You're saying no, the last class that we were doing. You're saying that one.
maybe from your demat account you can show the
Hmm.
any option and the movement of it, the candlestick or the Greeks.
We
That's
will,
what I'm
we
saying.
can
It would
do
be
that.
easier for them to understand.
We can open the
We
option
can,
chain from any website. You need
yeah,
not
Or
open
if
the
you
demat.
if
Option
yes,
chain
the
on NSE
option
website.
yeah, option chain we can find from the NSE website, but I guess today it would not be available. Let us check.
It will be available, sir.
Okay. Okay.
Here it is.
So this is for, you can see this, everyone?
Yes, sir. We
Everyone
can see
can see
this.
this?
Yes, sir.
Okay, so
Yes, sir.
this change that you're saying, this is for not a stock, this is for Nifty.
It is for Nifty. Yes, sir. Index.
Yeah, this is for the index. So we have option change for index. We also have option change for stock.
Yes.
So we can, let's try to see for stock, or maybe we can just we can get an idea from this one also. That's not a problem.
So we can search for a company also, for a stock also.
Sir, you go.
TCS,
Yeah. It will not come from here.
let's
So it will be
try
very
something else.
easy if you show it. Yeah, derivative market. Yeah, the derivatives
This one,
market
right?
over there. The third from, yeah.
Mm,
Over
I
here,
will
if
see
you
this.
yeah, here. So now stock option over here, stock options.
Good. Okay. So let us look at ICICI Bank. Okay, so now can you all see? Can you all see?
Yes, sir.
Yes, sir.
Right. So this is the same thing that we also in the derivative options also there was one screenshot available there. So there also we saw the same thing. So what is this? When you look
These
at
are
this,
the strike
these
price.
are the strike price wise, right? So strike price are basically the price at which you want to buy an option contract. So what is the current price of an ICICI Bank? Any idea?
Just a minute.
Scroll
It is
up, you
five.
will get it. Just
Yeah, it
scroll
is
up, sir.
500 some. Yeah, one second, one second. It is 500 something.
So 502.05.
Yeah, right, right. So this is the current price. So when you say current price, that means that's the spot price, right? So now these are the strike price which are available and on which you can actually buy the option contract. So if you want to buy an option contract, so this is for puts and this is for your calls, right? And that is giving you the last traded price at what price it has been traded earlier. Right. So let's go by one by one. Let's start with the call first, just to have a better understanding around the options. And probably, though the option Greeks, you would not be directly able to relate it purely as in what change it is happening, but you can have some amount of understanding around option is how it is being reflected there. So see, if you buy a call option that is with a strike of 440, strike of 440. So what kind of option you're buying at the moment? Just to we read three different kind of options that we can buy. What those three kind of option that we have? Not
At the money,
yeah, right,
in the money, and out of the money.
right. So at the money, in the money, out of the money. So when I buy a call option, with a strike of 440. So which option is this? Is it in the money? Is it out of money? Or is it at the money? Yeah.
Right. Deep in the money.
Okay. I want others to also. Bhavya, Harshit, Ishika.
Sir, can you repeat your question? I couldn't able to hear that.
No worries. So I'm saying I, as a option buyer, right? I am trying to buy an option with a strike of 440. This is the strike price which I listed for an option contract, right? So I want to buy an option with a strike price of 440, and the option price is, this is the option price. So 660.60 is the bid price which I'm quoting, and leave it the ask price what the sell price is there.
Can
This
I
is
answer?
the, hold on, not I'll name. I first want others to probably make uh, make an understanding around it, how it actually works, and then probably everyone can jump in.
Okay, sir.
Especially uh, people who are doing it first time, because I know some of you already know about options and also you would be finding it easier to understand, but for others who are not closer to the option market and all, for them it would be bit difficult, but don't worry about it. It is not at all difficult to understand. It's very easy to understand. So can you look at this option change? So this is the strike listed. So I can buy an option with a strike of 410, and I can buy a strike of 480 also, 500 also, 530 also. These are the different strike prices available for an investor to buy an option contract, right? So if I buy an option contract with a strike of 440 and I buy a call option, not the put one, I buy a call option with a strike of 440. So that means I'm buying which option? Is it in the money, out of money, at the money?
In the money.
In the money. Okay. Why, Harshit, it is in the money?
So when we buy call option, we think the price will go up in future. So so if the price go up and suppose the price will go to 440, so at that time we are in the gain side, and if we're in the
Okay.
gain side, that is in the monies in calls.
Okay. 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 Your answer is correct, but explanation is not uh, matching with the answer, so it is not justified. I need a better explanation why it is in the money. Anyone else would like to try? Sudiksha?
May I?
No, Vishal, hold on. I'll come to you guys later, because I know you know about options, so I'm not coming directly. I want others who are starting, as in who have not read option, who are just starting with the class, as in just studying option in the class. So I want them to first build understanding. Otherwise, it would be difficult for you to understand the other concepts and other things. I'm I'm saying bluntly, but this is the reality. If you're not grasp it right now, probably it would be difficult to build on another story or another thing about the option, especially because options are a bit tricky and options are difficult thing. That's the reason most of the investor population is found in the equity market. They are not found in the derivative market. There are very few people who actually take good positions in option, right? You can take even naked position. I'm not talking about a naked position, right? If you make a different sort of strategies, there the profit might be reduced also, but you try to play bit safe than to be exposed to lot of risk. So there are some strategies available which you can probably make use of and play safe. So, but before you actually make use of those strategies, you need to be able to understand from basics, like what it is and how it is actually going to work on ground, right? So Apurv, Bhavya, Anurag, Avinav, Ishika, Mayank, Harshit, good try. I uh, say it's a good try. Harshit really tried it, but the explanation was not thorough. No problem, but we can look at this again. Mayank, yeah, anyone would like to try, would like to make me understand why it is at the money, why it is in the money. The 440 strike that we were talking about, why this is in the money.
So what is the spot price in this situation?
Okay, you yourself told me. I scrolled up
No,
and
no.
you
Sir, is this a
can you please
67?
which one? This is the spot price.
67.
No, this one, this price. Can you see this? 503. Can you see in my cursor?
Yeah, yeah. Yeah, sir.
503.50. This is the spot price for the stock,
So because that is in
right?
the money, because spot price is greater than strike price.
Right, right,
That is why that is
absolutely.
the in the money. Now I get
Right.
it. Yeah.
Yeah, very good, very nice. So everyone got it now? Why it is in the money? Because this is something that we did in the first in the
Yeah,
previous
sure.
session.
Sure. Yeah.
Okay. Okay, now let's assume you take an option with a strike of 520. Is it in the money, out of money, at 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 the money?
Out of
Out of the money, sir.
Right, Siddharth. Yeah, out of the money because you are taking an option which is away from the
Spot
spot
price is
price.
less than strike price.
Right. So now this thing is clear. Look at the other things here. So when you look at the ask price and the bid price, so that basically shows how the investors are placed for the buy and sell of the option contract. So this is the call and this is the put, right? So call is basically you are bullish on the stock. When you buy a call option, what the call
It means
represent, it it shows that you are
bullish
bullish on
strategy.
the bullish, right? You are bullish on the stock and the stock price will move up. And when you buy a put option, so put basically gives you a right to sell the underlying asset at a predetermined price at a predetermined time, right? That is what the call option put option gives to an investor. Everyone clear? So when you look at call and you're buying a call option with a 520 strike, what does it tell? What does it reflect? You buy 520, what price you buy? Bid price is 13.75. That is the price you quote as per the example given here, right? And the bid quantity is 1375. When I say 1375, basically it means one lot. The one contract can't be less than 1375 for ICC Bank, right? This contract size can this size can differ. It is not same for every stock. It is different for different stock. For TCS, it is 600. For ICC Bank, it is 1375. One lot has this. For TCS, one lot has 600 shares, right? So that reflects you want to buy an option contract with a strike of 520 at what price? 13.75. Clear? And if there is a seller, he wants to sell it at 13.85. And the quantity the seller wants to sell is 2750. That means two lots. So there is a seller available who want to sell the same option with the same strike at what rate he wants to sell. He wants to sell a rate of 13.85. Right? Clear, everyone? A doubt? Still any doubt?
Sir, could you please repeat this one?
Okay, so these details which are listed here on the option chain, when you see these details, right? So there are bid price, there is ask price, there is ask quantity, there is a bid quantity, right? So what is the relevance of these things? So when you say you want to buy an option with a strike of 520, right? And you are quoting a price of 1375. So this is from the buyer point of view. So you want to buy an option contract with this strike at this rate, and there is a seller available also who want to sell a contract at what rate? 13.85 with quantity 2750. Right? So these details are clear, right? So we need to be clear with these details also. Everyone?
Okay, sir.
Okay.
Yes, yes, sir. Okay.
Okay, right. And then you see this price that you have. So with an example only, is when you buy an option contract with the same as in with this price. So this is the, from the investor point of view, it has been bought, and now you are going to hold it for a month, for 2 months or 3 months. There can be a 3 maturity available for 1, 2 or 3 months. Now it is not necessary for an investor to keep it until maturity. You can also offload the contract before maturity. So how can you do that? How can you do that? If you want to offload the contract before maturity, is it possible for investor or it is not possible?
Sir, in case of options.
In case of option, yeah. Like you've
Yeah,
taken
it's
a
possible.
position today,
Yes, sir.
you bought an option contract today. Now tomorrow you want to exit that contract. So how would you exit?
We'll just square it off.
Yes, right. So though the option contract is for a month, 2 and 3, but it is upon the investor, like how long the investor want to be invested in the contract, and that is how it would be. So in the exchange market it is easy, but in the OTC market it is not that easy, wherein you can't offload the position if you want to upload before maturity. So because the OTC market is designed with a aim to take care of the customization of the customer's requirement. So if a customer has got a different requirement, so basis that requirement, contract has been customized. And if customer wants to get rid of that contract before maturity, then customer has to find another investor who can actually buy the same contract. How that investor can buy the same contract when investor has got the same requirement only, right? So that is the reason it is easier to offload option contract or futures contract in the exchange market, but it is not that easy to offload forward and option contract in the OTC market. They are designed keeping in mind the requirement of the customer, so those could be difficult to offload in the OTC market. So any question? So this example that we covered here is just to give you a view how the option change look like. And when you look at this thing, OI, what OI means? Anyone? I guess
Open
we discussed
interest.
this thing. Yeah, we also discussed this thing in the last class, right? What is open interest? Any idea?
Open interest is something that number of contract open in a particular time.
Right, right.
Sir,
So
it
on a
actually
particular,
tells that how it
yeah, go
actually
ahead.
tells that how active the option is in the market.
Right, correct. So option contract basically gives you an idea how particular option is being traded and how many contracts are open and how many contracts are active, you can say. on a given day. So that gives you an idea, or you can say in another word, uh, there is one sense you can build by looking at the option chain. If the open contracts are large at one particular level, that also reflect the investors have a good confidence at one particular strike. So if there
Yes,
are
sir.
quite a huge open contract available at a given strike price, so investor might be having a good confidence at a given strike, the option might not move or pull down from that strike. So it is not always true, because the market has a huge volatility. It is not, you can just say it's a thumb rule. Nothing is a thumb rule. It is just an understanding that you probably try to make out by looking at an option chain. You can't be 100% sure it is going to behave or turn out to be in a very same manner. So option contract can give you some idea like how or where the investors find comfortable to stand, what they think is achievable with the option change, what they think is where the option, as in the share, can slide, to which level it can slide. So these are the few things which you can actually understand from the option chain, right? So similarly, like here, if you look at the put side, this is what we have seen. The call side, this is for the call, right? And this is the put side. So put basically
So,
shows, yeah.
so what is the meaning of this CHNG? This is term called after LTP.
Yeah, change in open interest. What is change in open interest?
Number of contract increase or decrease from the previous trading day.
Right. So
And
there can be,
answer this, and before LTP, that is IV.
yeah, what is
Implied
IV?
volatility.
Yeah,
Implied
right.
volatility.
Implied volatility is represented with IV,
IV.
right? That is
It's
Vega with that
IV,
thing.
the higher the IV, it shows that how actively moving the price of the option.
Correct. So higher the IV, so that basically shows the volatility is high and the price would be high at that level, at that particular strike. So if you look at here, you can see at this level your 41 is the IV. Oh, sorry, this is 32.32, right? And this is your 470. So strike is, at this strike the volatility is high, right? And at this point also 500, the volatility is high. Why? Because 500 is where the stock is currently sitting at, right? And it is expected to have a high volatility in this range. Stock may have an upside from here, can also have a downside from here, because already it has made a good run. Stock has already made a good run. If you look at in a real time, the stock was around 480 until yesterday or Friday, or Thursday rather, I would say, not Friday. And from Thursday to Friday, it has made a good run up till 503 is the stock spot price, right? 503. So at this level, there is a possibility of higher volatility, and it can go upside also, provided there is some good news, and it can also go downside if it doesn't stand the pressure at this level. So pressure, when I say, so it is a selling pressure, I'm saying. So people, if don't have confidence that it can further move up, then there might be selling pressure coming from the market, and people would like to offload their position, and therefore the price will go down. Okay, the same thing which you see here, what is LTP?
Last traded price.
Right, so last traded price is called LTP. Yeah, last traded price means at what price this has been bought and sold, right? So that
Yes,
is
sir.
represented with the LTP, and the current price is being reflected with the bid which is being put in by the investors. So this is just a one bid shown here. There can be multiple bid. When you actually see the actual system, there you can find the multiple bids shown in the system itself, like where the investors are placed, at what rate the investor want to buy a particular option. So this is just a one bid given here, one ask given here, right? So there could be different bid and ask for a same contract, for the same option, for the same option contract, so that you can actually see when you take position in option. And this is for puts, the same thing is there also. Two prices, so at what rate the seller wants to sell it, at what rate the buyer wants to buy it. So you have put in your own price, you're not going with the market price, so you can also buy with the market price. So market means the price which is running in the market, so you can just go and buy at the same rate also, given the option has high liquidity. If option doesn't have high liquidity, then probably you will not be able to buy at the market rate. So market rate also changes very very frequently in the options market, or rather in the equities market also. So you can buy an option. When I say market rate is basically the the rate which is running at the moment, that is called market rate. And the bid price is something which you can also quote, as in you want to buy a particular option at 100. So that means you have quoted your own price, you just want to buy at this rate, right? And then it depends, there is a seller available to sell it at that rate. If there is a seller available to sell at the same rate, then you can buy, you would be able to get the option contract the same rate which you quoted in the order, right? Clear everyone, or any doubt further? Okay.
No, sir.
Okay, now let's try to talk some of the strategies and understand how they are there. So covered call is a strategy in option trading whereby the call options are written against the holding of an underlying security, right? So this is a strategy that is called covered call. So what we are actually doing with this strategy, we are already having a number of shares with us. So example is, you have 100 shares, you have bought 100 shares from the equity market, right? And you have sold one call option. So why would you do that? Because you want to you want to why would you do that? Why would you sell a call option? You are
To cover
covering
the
the
risk.
call, to cover the risk, right? And the risk is, what's the risk here?
Risk is if the underlying asset going price of the underlying asset going down.
Right, so that's the risk, right? So you would not be able to cover the entire risk for sure, right? But what you're trying to do here, you probably want to hold that number of shares for a short period of time, maybe for 15-20 days, and you are bullish on the share, right? You are bullish on the share, and at the same time you want to mitigate your downside risk. So you can have a feeling, or you can have you might be having this thought, maybe the price may slide down to few rupees. Example we can take for the ICC bank only. So you have a ICC bank share, you bought it at for 500 rupees, right? So now what you do, you sell a call option. So what the call option would do, what the call option will do, call option will give you premium, right? And that premium will compensate if the share slides a bit in the price. But would it be able to compensate fully? Maybe assume the share goes 20 rupees, and the call that you sold is only for 10 rupees, and just making up this number, right? So then it would not be able to cover it fully. But this is the strategy wherein compensating you to some amount. So, and this is the covered call. So let's look at this entire statement, then you can make out what we are trying to do here, right? Using the covered call strategy, the investor gets to earn a premium writing calls while at the same time appreciate all benefit of underlying stock ownership such as dividend voting right, unless he is assigned an exercise notice on the written call and is obligated to sell his shares. However, the profit potential of a writing covered call writing is limited, as the investor had in return for the premium given given up the chance to fully profit from substantial rise in the price of the underlying asset. Out of money covered call. This is the covered call strategy where the moderately bullish investor sells out of the money calls against holding of the underlying shares. The OTM covered call is popular strategy as the investor gets to collect premium while being able to enjoy capital gains if the underlying stock rallies. So what an investor is doing? Investor is selling out of money covered call, and you are already holding a share of that given company. Example is ICC Bank. Here we are taking a lot of 100 shares, which is not the ideal case. We know the lot is of 1375. ICC Bank का lot जो है वो कितने का 1375 का है. But assuming the lot is of 100 shares, so you already have 100 shares in your portfolio or in your demat account. Now you also take a call option. You sell a call option, not buy. So with this, you are selling an out of money covered call. You say out of money. When you say out of money, that means you are selling away from the spot price, right, everyone? So look at this example, try to understand what it talks about, and then anyone clear with this? Anyone able to understand? There are two, three things we're talking here. It's very straightforward. Okay, Siddharth.
It's basically to mitigate the risk.
Right, right. It is being, yeah, covered, as the word says, covered. You kind of covering sort of a risk.
Sort of an insurance sort of a thing, like insuring the
Yeah,
cover.
yeah. So what we are doing, option trader purchases 100 shares of XYZ stock trading at rupees 50 in June, right? And writes a July 55 out of money call. तो हमने क्या किया?
What does this mean? Writes July 55 and writes July.
Right. Right. So when you say right, July 50 means right means sell. We can also right writer sell in to seller we can say writer of money July option of 55. Why it is out, right? XYZ stock trading at 15 June of 100 shares, $2 is the premium amount. So he pays 5,000 for 100 shares of XYZ and receives 200 for writing the call option, giving a total investment of 4,800. Right? Clear everyone? आपने क्या किया? आपने 100 shares खरीदे हैं जिसकी amount and each share is $50, right? 50 into 100, 5,000, and you at the same time in month of June itself sold out of month of July. You sold an July option, that means a month ahead, out of money call option you sold, and for that option you got a premium of 2 rupee, $2, not rupee, $2. So that means you got $200 on 100 shares. So now your investment is 4,800 rupees, $4,800. Why? Because the $200 that you earn from the option premium, you are taking it. So therefore your total investment, I'm not taking commission stuff. Commission होती है आपको when you go for not taking and all that. Be an option share buying. Like go for a share buying, you also doing some courage and all that. That I'm not taking, right? When you go overall the payroll, so that to account at the moment, I'm just looking purely technical point of view, like how it would purely yeah.
Hello,
So
hello, sir, Prakash.
your voice is it Prakha?
आवाज ही नहीं आ रही। मेरी को आवाज नहीं सुनाई दे रही।
We can hear you.
Sir,
Prakha, go ahead.
what I'm saying that in this statement it is told that the stock has rallied to $57. Okay, and since the striking price is $55, so here is a profit of $2, and also the price at which the trader has brought the call option is also lower. So that's why I think there is a price factor of $200 is there. Because because since there is a profit of $2 on the strike price, and since the stock has traded at high price, that's why.
Okay, fair enough. Anyone else? Anyone else who's clear with this example? The 700 profit is clear. Anyone has any doubt why the profit is a $700? So the example is straightforward. If stock rallies to $57, right, and you bought it at $50 in June. Now it has gone to $57. So it has run 7 points up from where you bought it. So 7 into 100, 700 plus 200 is your option premium. So it is 900. Isn't it 900? Shouldn't it be $900? Right?
Sir, your voice is breaking, sir.
Okay, my voice is breaking. 1 second. Give me a second. Let me
Sir, your
just.
voice is breaking.
Okay, give me a second. Let me just check. Let me check the connection. 1 second. Give me a second. Yeah, yeah. Is that better now? Can you hear me?
Yes,
Yes,
yes, sir.
sir. Now your voice is audible, sir.
Okay, okay, fine, fine. Okay, so I was asking, let me just rephrase my question, which I was asking you. So I'm saying, we are talking a profit of 700 here in this example. This brings his total profit of $700. Shouldn't the profit be $900?
No, it will be the
No,
total
sir.
profit of
No, sir.
total profit will be 700
Okay, fine. Uh,
because
okay,
because
The
because
total profit.
yeah, one by one, one by. Yeah, Sumit, go ahead.
yeah, because we bought the stock at $50 and which went to on expiry at 57 rupees where we make a profit of around $700. Uh,
Hmm.
but in option we sold the strike price of 55 at a premium of 2 and
Hmm.
expiry it is around 57. So
Hmm.
2 rupees premium will be negotiated uh, with the option premium on expiry which will be the 2 rupees and it will be zero. So the net profit will be the 700 rupees which we earn on the shares we hold.
Okay, but the premium you already received, right? There would be no
Yeah, we
zero.
received, but it will be negotiated on expiry date. No, it will be it becomes zero on expiry date because rate is raised to the 57 dollar.
Okay, okay. So what will actual thing happen on the ground on ground? So you are on track, but there is one statement which I'm looking for. One particular statement. Your answer is correct, and almost the things that you said are right. There is one more line I'm looking for. That particular line that you want to rephrase. Anyone else?
So his total profit would be 700,
May
but
I?
if we actually
Okay.
see, the
Mhm.
am I audible, sir?
Yeah, you audible. You audible. Go ahead.
But sir, I think the net profit would be, sir, around $500 only.
Net profit would be only $500. Okay, fine. Okay, okay. What about others? Harshit?
Yes, sir.
Yeah. What
Yes,
what
sir.
are your thoughts?
Sir, in this the $200 premium is included in 700. That is why the total profit is 700, which in this the premium is already included, and the net
Hmm.
profit is $500.
Net profit is $500.
Yeah, and
No, the
if
premium is not
and we
included.
No, but
I don't think the
let's.
premium is included.
Okay, okay, fine. So
Uh, that is $700 because the share price jumped from 50 to 57 and he bought 100 shares. So that is why his total profit only on the shares is $700. But
hmm,
he actually sold the call option. And when you
right.
sell a call option, then you sell it because you think that it might go down. The price of the stock might go down. So if I, you know, come under any loss, then I'll recover it through the option.
Hmm,
So he
hmm,
paid a premium of 200 rupees for that, for selling that call option, and the
hmm,
price actually skyrocketed. Not skyrocketed, but it moved from 50 to 57. So in that
hmm,
case, the value of the call option will go down because he sold it.
hmm.
So
Okay.
at some point, the value of call option will become zero, and his 200 premium will be gone. So his actual profit would be net $500, I think.
Okay, okay, fine. Okay, and okay, anyone else? Harshit, you want to say? Ishika, you want to say something? Sudiksha, Ishika, Mayank, Prakhar. Prakhar said already, right? Bhavya, no one?
So may I?
Yeah, Vishal, now you go ahead.
So may I?
Yeah, yeah, go ahead.
So we can see this as two contracts.
Yeah, who is this? Bhavya. Bhavya is saying something, right?
Am I?
Let Vishal take that.
No, let
Uh,
Bhavya, you maybe you complete first,
No,
then let Vishal
Whether you
no,
can
no,
go.
Bhavya, yes,
no, no,
please.
no.
Yeah.
Let Vishal do that.
No, no, let you put your thoughts before, because I know Vishal would be knowing this. So let your thoughts come
Yes, sir.
first. Let
I'm kind of having a bad connection, so the voice
okay,
was not properly audible, and my battery also died a couple of minutes ago, so I just joined back.
okay, no worries, no worries.
Yes, sir.
Okay, so then probably Vishal, you go ahead.
So as it is given, Mr. X, he bought 100
Yeah.
shares at a rate of $50 each,
Hmm.
which brings out the total investment to $5,000. Now
Okay.
to mitigate his risk, he,
Hmm.
he creates a position in options.
Hmm.
He shorts the call option for a
Right.
premium of $2.
Correct.
Now he's got a premium of $200, which brings his total investment to $4,800, as he has
Hmm.
received $200 back from the position made in call option. Now on the
Okay.
expiration date, the stock has tallied to $57. Now, if Mr. X sells his shares, he'll get a profit. He'll get a profit of $7 on the first transaction that he made for shares.
Okay.
But for the position made in options, he'll have to square off the position and buy back the shares, as he earlier shorted to short them.
Hmm.
So the $200 investment that he has made, he had to return. The 200 premium that he received, he had to return, uh,
Hmm.
because he has to square off the position. Instead of doing
Right.
that, as the strike price is since the strike price for the call is lower than the current trading price,
Hmm.
the strike price is lower than the current trading price, then he actually made the contract, which he actually, what we
Hmm.
say, put the
Right.
contract live, and he sold the shares to the person to
Hmm.
whom the contract was made,
Right.
and the shares were sold at $55 at the striking price. So in this
Hmm.
case, he doesn't have to return the premium of $200. Profit
Hmm.
remains the same, that is $700.
Hmm. Right.
This is the case
So
explained here.
right. So right.
Sir, what like Vishal said, he don't does not require to return the premium, but his premium will be become zero, na? Premium will become
No
zero. Or
premium.
here he has to return the premium
So
of
may I?
rupees two. So that that's the reason that's the reason the his option value reduced to zero. Otherwise, if he not return the value of rupees two or dollar two, how can he can say he can say that it is zero.
No, you're given
So may I answer
because
this?
uh, okay, okay, you can go ahead. Yeah, okay. Yeah.
So as we know, in a for derivatives contract, at the expiry, either we have to do the contract, or we have to we can
Yeah.
just go away. In an options contract, we can let the premium go away on when we short a position. When we short a position at the end of the day or at the end of the expiry, we have to square it off. We have to buy back.
Right.
When we buy the, if we make a position in buy, if we make the position in the buy side, then we can let go of the position. But if we make the position in a short side, then at the end of the expiry or at the end of the day, we have to square it off by buying it back.
Hmm. Hmm. Hmm.
When you
Okay.
buying
Right.
the
This is
when you're buying it back, that
this is
means
this is
you are returning the premium, na. That's why when you buying back it on
yes.
expiry,
When we are
that you are returning. So you earlier that you earlier told that we are not returning the premium. Here you are returning the premium because that is the
yes,
reason that your option value reduced to zero, and the total profit is 700 is totally belongs from the cash market stock, which is you purchase
mm,
100 stock.
Okay.
in
Okay. So, okay. So
in
just
this
to put it
particular case,
into,
in this in this part, yes, sir, you go ahead. Yes.
okay. So just to put it into, as in, put it into context. So maybe we are understanding correctly. The words that we are choosing may be different. That would be the reason why different thoughts are there. That's fine. That is fine, because when we look at a particular example, we might be having a different understanding in terms of how we, maybe Sumit is saying returning the premium is where the loss is coming, so that is what he is saying, he's returning premium. So yeah, which is okay, because you're saying you are incurring loss, so it is a kind of a return of premium, but in real sense you would say the premium you have already received. If I look at this in a normal way, you have a stock, you taken a position, two position, one you have bought number of shares, that's 100 shares for XYZ stock, and now the stock value has risen, it's gone to 57, so you are making profit on stock for sure, right? So 7 rupees profit on each share, which amounts to $700 in stock profit. But at the same time, you have also sold a call option for a strike of 55. That means once a share is trading above $55, then you are bound to sell that share to the person who has bought a call option from you, right? What the call option sorry sorry what a call option gives to the buyer, call option gives the right to the buyer to buy that call from the seller at predetermined at a predetermined time or date, right? That's the feature of the call option, right? So if it moves beyond 55, so then the buyer can demand from you to sell it. And how can you sell it to the buyer? Either you buy it from the market, or you close your position on the last day of the trading. So you can yourself close your position, you can buy, you can leave it. So either ways the situation would be same. So you can close at a loss, so you can buy the same option you buy from the open market, that would be available at that given day. At what rate? It would be available for 7 rupees, right? 7 rupees, so that day. So that loss which you would be having of, so 5 rupees profit is already which is coming from your share, right? And 5 rupee 2 rupees loss would be there with your option going to 57 rupees. So 2 rupees loss would be there, right? Because the 5 rupees loss would not, as in this, when you look at the 7 rupees, 7, when I say 7 rupees loss, 7 rupees is not the actual loss is only of 2 rupees. 5 rupees is actually being recovered from share value, right? So there are two things happening. One, you have a long position on shares, so when share moves at 55 rupees, so though that profit is with you only, right? That profit will remain with the investor, because you have sold a call option at 55. So only when the stock moves beyond 55, then only you are bound to sell that share to the investor who has bought it from you. So that point in time, so that means the difference, if it moves those number of points, whatever number of points it moves above 55, that is the loss which the seller incurs. So here it has moved 57, So and you sold it at 55. That means 2 point movement has been there in a stock. So $2 loss would be to the investor who has sold the call option, and at the same time you make a $5 profit by selling those shares. 5 plus 2, 2 from your call option that you sold, that is also a profit in a sort of in the form of premium. So 200 premium plus 500 profit which you generate from the share, or you can say so whichever way you say, you can say 700 profit. 700 profit you bought from the shares that you sold at 57 rupees, or you can also say uh, you will have to you would be losing $2 from the call because it has moved beyond 55, right? So whichever way you say, you can have a different interpretation, but the net profit would be 700 only, $700, which the investor would be able to make, right? Any confusion, any doubt, anything not clear? Everyone?
Sir, I am totally clear because I already worked on these strategies.
Okay, okay, fair enough. So, right. So now let's look at the second option, statement. Second statement is here at $43. Uh, at $43, the call writer will incur a loss of 700 for holding the 100 shares of XYZ. However, his loss is offset by the 200 premium received, so his total loss is $500. In comparison, the call buyer's loss is limited to the premiums paid, in which is $200. Any confusion with this statement? What this statement is telling us? If the stock price moves down to 7 points, what will happen? That means the stock price is now $43 instead of 50, which was in June. Now in the month of July, the stock has moved to $43. What is happening here? Is it a loss? Is it a break even? What is happening here? Yeah, anyone can quickly explain, because now we are done. We're done with this. So this is just a last statement that you need to explain in relation to the same example that we are doing.
Sir, in here you have
Yeah.
to your total loss will be 500. 500 loss
Yeah.
because you hold the stock which is
Hmm.
which reduced to $43 per stock per share. That means you
Hmm.
have made loss of $7 per share. Okay,
Right. Hmm.
where you have made for $700 per share loss uh, in the shares which you have bought earlier,
Hmm.
and
Right.
in call position you have sold the 5500 strike price at the premium of 2 rupees. You will receive
Hmm.
the premium of rupees 2. So you made a loss of 700 in the shares, but you received 2 rupees of premium in the option. So your total loss would be $500.
Right. Right. So this is clear, right? It's there is there is this is straightforward. There is nothing uh, there shouldn't be anything difficult for everyone. I'm saying we should be clear with this statement. There is uh, no difficulty at all. I can see, because it's very straightforward one. Let's move on to the next example. So this is a payoff diagram which is shown, like how the payoff and what all points would be the break even point. So this is how the payoff diagram would be made for covered call. So the 48 would be the break even point. So if the stock moves beyond to below to 48, there is no loss, no profit to the investor, right? And 55, if it is 55 here, that is the point where the profit would be maximum. Agreed, everyone? Where is the maximum profit to the investor? This 48 is the break even point. Everyone agreed? Break even, what is break even? First of all, any doubt? Do let me know if you are not clear. No profit, no loss, right? And what is the highest profit for the investor? Which point is the highest profit? Which is the highest profit? Yeah, 55. Vishal said it. Okay. Everyone clear, right? Okay. Now covered put.
Yes, sir.
Okay. Writing a covered put is a bearish options trading strategy involving the writing a put option while shorting the obligated shares of the underlying stock. Covered put construction. So how it would be constructed? Give me a second. Okay. So this strategy, wherein one is the covered call, another is the covered put, it works in a very similar manner as the covered call work. So construction, you can look at the construction here. There is example. You are shorting 100 shares, right? And sell one ATM put. Suppose XYZ is trading at a 45 in June. Let's come directly to the example, and then you're probably able to make it out completely. XYZ stock is trading 45 in June. The option trader writes a covered put by selling a July 45 put for 200 while shorting 100 shares of XYZ. The net credit taken to the enter the position is $200, which is also maximum possible profit. On expiration in July, XYZ stock is trading at 45. The July 45 put expires worthless while the trader covers his short position with no loss. In the end, he gets to keep the entire credit taken as profit. If instead XYZ drops to 40 on expiration, short put will expire in the money and is worth $500, but this loss is offset by the 500 gain in the short stock. Thus, the profit is still the initial credit of 200 taken on entering the trade. However, should the stock rally to 55 on the expiration, significant loss result. At this price, the short stock position taken when XYZ stock was trading in 45 suffers a loss of $1,000. Subtracting the initial credit of 200 taken, the resulting losses to 800. So, what is happening here? Who could understand the whole thing? Okay, just read it out and try to understand. Yeah. Take 2 minutes, read it out, and then try to understand what we are doing here. What is happening in this strategy? Clear, everyone? Any doubt here? Who would like to explain it quickly? Because this shouldn't take much time, because when you clear with the covered call, I don't think it should be difficult for you now. It shouldn't take more than 2 minutes. People who have not spoken, probably I would expect them to take a lead this time. Ishika is not there. Ishika is okay. People have dropped. Ishika, Sudiksha, is there a network issue, or yeah, Sumit?
No, no, I'm just saying the all good, sir. Network
All
is
good,
good.
right? Network is good, right? So why? Because I don't understand why we are not, as in why people are confused, as in, because if you are not on the session, probably whatever little you can understand, that will also go off, right? And who all dropped? Why we are fearing from this option? I guess it is more of a fear which is not which is not allowing you to move ahead, right? There shouldn't be any fear. It is very simple. It is just you need to put in a bit of a brain into it. That's it. It's not difficult at all. It's very easy, to be very frank. Bit of a patience is needed. 2-3 readings are required, and you would be very comfortable with the whole stuff. It is in the initial stage, it would be a bit difficult. I understand. It happens, and it happens with everyone, right? So, but you need to be there. Whatever thought comes to your mind, you need to talk about that thing, and that is how you actually increase, and you would be able to learn better about the options and all. So if you look at this particular, let me just explain it for you. So what has happened here, and then we will move ahead. So if you look at this particular example, what the trader is doing, what the investor is doing, investor is shorting 100 shares, right? And also at the same time selling one ATM put, right? So when you're selling an ATM put, you would be getting a premium for selling the put. So premium is, what is the premium? That is $200. The same $2 per share is the assumption made. So net premium is $200. That's given there. Net credit taken to enter the position is 200. And when you are selling the shares, so assumption is made, you're not buying anything, you're selling there, so no money is being used there. But that is not the case. When you even sell shares, you would be taking a position in futures only. But let's go with the example, what the example is saying. So 200 profit you have made by taking this position. You have sold 100 shares, that means shorting 100 shares, and at the same time you are also selling one ATM for the one ATM put, right? For selling the ATM put, you are getting a premium. That premium is $200. Now what is happening on the expiration? On expiration in July, if it expires at 45, July 45 put expires worthless. If it is trading at the same price, that is 45, that means that the put expires worthless, and you happen to keep the entire premium, that is 200 rupees. So that is your profit. That's the only profit you are making. Now another situation is when the stock moves down, right, and it goes to 40. So that means you would be able to make profit by shorting the position that you have short, right? The position that you have short, you would be making a profit with that and that profit is the same difference in the stock value. So what the difference in stocks, 45 to 45, so 500 profit you have made, but at the same time you have also sold in the stock position. You have also done a shorting of 100 shares, so you would be making a loss there, right? So that 100 loss, that 500 loss in the short position that you have made will be offset by the profit that you have made in the the 500 profit that you made in the short position will be offset by the 500 loss that you made in the selling of one ATM put. So that is offset. So your net credit or net profit would be only the premium that you have received with this option that you sold, right? So that is with this statement. Now another is, if the stock moves to $55 expiration, then there is a significant loss result. At this price, the short stock would have given you how much loss? You have done a short at 45, right? Now the $10 move which has come in the value of the short position, that means $1,000 loss, and you have made a profit of 200 with selling an option. So that means the net loss would be $800. Any confusion? Any confusion here now? Or anyone want to explain it in maybe in other words? Okay, so let's move on quickly. So this would be the payoff diagram for this covered put. So your profit, maximum profit, if you look at this, would be the 45. If stock trades at 45, that is the maximum profit that you can make, right? So that is the covered put strategy. If it goes 40, then also the profit would be 40 for $200 only. If it goes to 35, then also the profit would be same $200. But if it goes up, then the profit would be, there would be no profit, there would be loss. And what would the break even? What is the break even here? What is break even in this particular payoff covered put? Yeah, tell me quickly. It shouldn't take second. Harshit, what's the break even here? Mayank is there. Mayank, what's the break even?
Hello,
Yeah, Prakash, go ahead.
sir. It will be 47.5 or 48.
Okay. Okay, fine. What about others? Harshit,
Yes, sir.
what would be break even in this particular example that we are discussing now? Hope we are clear with the example that we are discussing, or not clear with the example itself. Siddharth, you clear?
Yes, it's 47.5 what I believe.
Okay. Sumit,
Yes, sir.
what should be break even here in this particular example?
Sir, I missed the question actually. if you if
Oh,
you
no worries, no worries. So I'll repeat my question, right? The question is, right, so there is the construction that we have done, right, for covered put is this. You are shorting 100 shares, right? And
sir
selling one ATM
give
put.
me sir, give me 1 minute. I just read it and I will answer you.
Okay, read it. Everyone in the meantime, it is for everyone. It is not for only Sumit. I will ask everyone, and maybe the answer has already been given or not given. I'll not tell you what is the answer right at this moment, but You should be clear with the example.
Sir,
Yeah, Vinam, what are you saying?
sir, 50 is break-even point.
50.
Sir, 50 is
Okay.
break-even point.
58.
No, sir, 50, 50.
50. Okay, fine. Fine. Okay. Okay. So can you explain how 50 is break even? How 50 is break even?
Sir, because trading price is 45 rupees in a June. Sorry, trading price is 45 and rally trading price is 55 and mid price is 50.
Okay. Okay, fine.
Sir, here the premium is $200.
$200 premium in a sense, it's a total premium, not
Okay.
in a
Then
yeah.
if the stock is still trading at 45, then in the cash market, profit and loss will be zero, and in the option market he will receive the total premium of rupees total premium of dollar 200, and it is the total profit of
Okay, fine.
in this is in this total transaction.
Fair enough, right? Okay. Okay, fine. Hmm. Sumit, I can't hear you. I guess he has the issue with his connection. So everyone else, Vishal, Vivav, what should be the break even in this case? Your thoughts? Harshit has said 45, 47.5. Mike has Prakhar has said 47.5. Yeah.
Sir, I cannot come to the exact number, but I
Okay.
think that it should be between 50 and 47.
50 and 47. Okay, fine. Okay, so just don't go by this representation as in the graph alone, right? So graph may be slightly here and there, because if you look at graph, it is basically showing you the midpoint, right? That is why probably most of you, as in Harshit and Prakhar, are saying 47.5. But don't go by this graph entirely, right? We need to go with the technicals that we have before us. So if you look at technical, I guess Vishal has already given a number, that is 47, which is correct, right? So 47 is break even, that's right, because if you look at break even is basically no loss no profit, right? We all know break even means no loss no profit. So when can you have a break even? That means when the stock is standing at 47, right? That is when you would be having no loss. So yeah, Sumit has also given an answer that 47, right? So 47 is break even, right? Everyone clear? Because you are making a profit of $200, right? So if a stock stands at 47, you would be losing $200 from the stock market, because you are shorting 100 shares, right? You are you are shorting 100 shares, so that means now you will have to buy at 47 to cover the position. So $200 loss there will be compensated with the $200 profit that you made from the option market, and therefore 47 will become your net profit, right? Everyone? Okay, let's move on. Okay, so this is another strategy now. This is called bull call spread. So bull call spread option strategy is employed when option trader thinks the price of underlying asset will go up moderately in near term. Bull call spreads can be implemented by buying an at the money call option while simultaneously writing a higher striking out of money call option of the same underlying security and the same expiration month. So this is how the bull call spread is created. So the underlying message is you're making this strategy. Bull call spread is made when the investor believes the stock will be moving up, but it wouldn't be extremely bullish, right? So you are not extremely bullish on a stock. You have a feeling the stock will move up, but it wouldn't be very it wouldn't be so strong as in it will just surpass any number. It wouldn't be like that. So you are moderately bullish, you can say. In a sense, you are moderately bullish. So that's the reason you are applying this bull call spread strategy. So what this strategy is all about, you're doing two things here. So how the construction is being made. So you're buying one ATM in the money call option and also selling one out of the money call option, right? So by shorting the out of money call option, the option trader reduces the cost of establishing the bullish position that foregoes the chances of making a large profit in the event that the underlying asset price skyrockets. The bull call spread option strategy is also known as bull call debit spread, as a debit is taken upon entering the trade. Right, so this is the strategy. Why we are also calling it bull call debit spread, because if you look at this strategy, the construction that you're doing by making this strategy, you would be incurring some loss at the initial stage. In a sense, you would be paying money, and the premium that you would be getting from the call option would be less than the premium that you would be paying. So that means there would be a net debit in your account in the initial little point, but you can make profit when this call option which you have bought in the beginning actually plays out in your favor. So how that can play out, because the intention behind making this strategy is the stock or the or there would be uptrend in the market, therefore you are making this strategy, right? So when there is a upside in the option, so you would be making profit with the help of your in the money call option, right? And why you're taking out of money call option, because you want to, one, reduce the expense that is there for buying in the money call option. At the same time you have this notion in your mind that the price of the share will hover around this range only. In a range, the price of particular share will remain. That's the reason you are making this strategy. So let's look at this example now. Yeah, read it out. Okay, after this probably we'll take a break, right? And then we will be doing these few examples, and will yeah, read it out, this example, and probably make me understand, because I expect everyone should be clear now, because it is only this thing which is important, right? Rest all is same. In every example you will find this is not a difficult thing to understand, and this is all same that you have seen here also, and here also, right? All these examples are quite similar in nature. It is just a strategy how you're making. So this is important. How you constructing strategy, that's important, that's more relevant. And this thing is not, this is just a technical, right? It will be same everywhere, every example would be same. You just need to focus, read the statement, you will realize it is same. It's nothing difficult to understand here. So let's take 2 minutes to read it out, and then probably come up with your narration, come up with your explanation, like what you think about the whole strategy, what we are trying to do, or what we are trying to achieve with this. Okay. Done? Everyone?
Yes, sir.
Done, Sumit?
Yeah, yes, sir.
And what
I
about
read
others?
it.
Clear with this example? Anything confusing, not clear? Why we are doing this strategy? Why? What's the idea behind doing this strategy? Everything?
Sir, hello.
Yeah, Prakar.
Sir, how we will find the construction in this example कि कैसे कंस्ट्रक्ट किया है इसने स्प्रेड को, बुल कॉल स्प्रेड को, ये एग्जांपल से कैसे पता चल रहा है देख के? मतलब मैं तो फाइंड ही नहीं कर पा रहा हूँ.
Oh, sorry, I was on mute. I was on mute and talking. Okay, so I was saying like the construction, when you look at the construction, this is the construction for bull call spread, right? And the important thing is these numbers may different for different stock and all that, but this this thing would be applied, right? This thing would be applied, right? So you just need to focus on the words, what is happening here. Then you can probably make out what exactly we are trying to achieve. Prakash?
How we can correlate that thing, like one ITM and one out OTM
Okay,
in the
okay,
money and out option in this uh, 40 and
good point.
45, how we will like sync or how we will correlate these things.
Very nice, very good point. Okay,
If
so who would
I am
like?
reading this example,
Okay,
for me the interpretation is that then a stock trader is like having a stock which is priced at $42, and it is the rally will be soon, and the bull call spread by entering a 40 call option for 300 and writing a 45 call for $100. What it mean, like 40 call for $300 and writing a 45 call for $100?
okay, okay. So when you
I'm
see
not
this
able to
July,
understand these
okay,
concepts.
good point. So when you look at this July 40, right? So this is basically means it's an option contract wherein this 40 signifies the strike price, right? This 40 signifies the strike price, and July is the month for which you're taking the strike. And similarly, when you say July 45, so that means 45 is a strike here again, and July is the month. Now you need to look at strike and the current price, the strike price and the current price. So with the strike price and current price, you can make it out whether this is in the money or it is out of the money, or it is at the money. So all these things you can look at from the strike and the current price, the stock's current price. So the current stock price is $42, and when you look at this July 40, so July 40 is below the 42, right?
Yes, sir.
Right. So are you in the money or are you out of money?
In the money. Sorry,
Right?
In the
in
money. In the,
You are in the money, right?
yes, sir. Yes.
yeah.
Because you can straightforward make $2, right? If you buy at 40, you can sell it at 42. That's the
Yes.
spot price. So that means you are in the money. Uh,
Yes.
it's a good question, Prakash. So because we need to be clear with these things, everyone
It
has
will
to
be
be
at
clear.
the money.
Yeah,
It will be at the money.
it would be at the money. Okay, okay,
So
yeah.
So 40 is a strike price.
What, yeah, when you look at this July 40, when the word 40 is written, that means you are actually talking about the strike price. When you look at this July 45, so that means you are actually talking about the strike price, right?
And the 42 is a spot price.
42 is the trading price, that means the spot price in the month of June, because we are talking in June, right? Believe XYZ stock trading 42 is going to rally soon and enters the bull call spread by buying in July. So this is a June, like the same example that we are here also we're talking about June, right? This 50 in June, right? Stock trading at 50. So this is the same June thing. In
We are
42
in
is
so we are in the money situation when strike price is more than spot price.
when this strike price is
More than the spot price.
okay. Fair enough. Yeah, very good
So,
point.
if the strike price is less than the spot price, then how can it be a in the money situation?
Okay, very nice.
ये भी
Very
क्वेश्चन
nice.
सही पूछा
How?
है। अब ये क्वेश्चन
हाँ.
पूछा है जो लोगों के दिमाग खुले जो किसी ऑप्शन में समझ में नहीं आता इन लोगों को।
बताओ कैसे होगा ये गुड पॉइंट ही हैज रेज्ड अ गुड पॉइंट बट ही वी नीड टू लुक एट इन द मनी एंड आउट ऑफ मनी फ्रॉम टू डिफरेंट एंगल
Yes, sir.
so look at yeah so this would be this would be at the money or in the money what it would be he has raised a good question right Harshit
Can you
Yes,
can you
sir.
repeat his
Can I
question?
answer?
Vishal okay no 1 second Mayank would you like to try or someone else who hasn't spoken so far I guess Mayank hasn't spoken Mayank with you okay Vishal you go ahead
So,
okay
as you said, we have to look at from two different perspectives.
yeah mic is not working
Hello,
fine no
sir,
no
am I audible?
yeah yeah you audible yeah fine
Sir, am I audible? As you
yes
said, we have to look at from two perspectives, from a call option point of view and a put option point of view. If we look at it from call option point of view, then the strike price should be less than the spot price to be in the money. As we say, as we just saw in the option chain, when the strike price is less than the spot price, then we'll be saying that we are in the money. And when the spot price is the strike price, then we'll be at the money. And when the strike price will be more than the spot price, then we'll be out of the money. And when we look at the point of view of put option, then it will be reversed. When we are when the strike price is more than the spot price, then we'll be in the money. And when the strike price will be less than the spot price, then we'll be out of the money. So this is the case.
right absolutely so
So here the question is talking about the here the option.
right correct
So
correct
in the call
so
option, when the strike
yeah
price is more than
yeah go ahead yeah you complete first
yes, as we see in this example, the strike price, which is 40, is less than the spot price, which is $42. July 40 call for $300 is the strike price is 40 and the spot price is 42. So we'll be in the money. And similarly for the
right
next option, when the which is July 45 call for $100, the strike price is more than the spot price, which is 45 is more than 42. So it will be out of the money.
right
So this is it, sir.
so Correct. So everyone got the idea what we are talking. Options are a bit tricky, so we need to look at in the money and out of money in two contexts, two different contexts. So, and these two contexts are given in the last session that we covered in the presentation that we had, the options one derivative option that we did. So we also talked about the in the money and out of money from two different directions. It is from two different direction you will have to take it. So you are right, Harshit. Like when you look at the strike, the relation of strike price and the spot price, right? So there are two different relations available. It is for the one is for the call option, another is for the put option. So in call option, the strike should be less than the your current price, then you would be in the money, right?
Yes,
So then
yes,
you
sir.
would be able to make, right?
Yes, sir.
Got the idea, right? So here what we are doing, we are actually able to make profit. How the profit is being made, is this clear? Everyone clear with the example, like how we are making profit, how and what is the idea behind this strategy? This should be clear. So as the
Yes,
name
sir.
suggests, bull call means you are expecting the price of a stock is going moderately up, and therefore you're taking one in the money option, and at the same time you are selling one out of the money option, right? So that's the reason you're doing that. And you, by making this strategy, you can see you are making a profit of how much profit you're making at the end of the contract. This is given in this paragraph, right? The complete paragraph talks about the profit and loss, how much profit and loss is being made. How much? 500?
300.
300, right? So how that 300 is there? Because you have bought one call option, and you sold one call option. So the net is a debit, which is why we call it a debit spread also. This strategy is also called a debit. Initially there would be a debit in your account. You are buying in the money call option, which is costing you $300, and then at the same time you also selling a call option that is out of money call option, and where you are receiving money. So net is 200 debit, and then when you see the stock moving up, it closes at 46 on the expiration. So both the options expire in the money, right? Then both the options which you have, one is a 45 call, another is 40 call. So both are sorry, both are in the money now. But now you know, since you have already bought one, so you would be making profit on the one, and after 45 the profit would not be yours, that would be the person who buys that option from you. So that $1 gap after 45, that profit will be of the person who has bought it from you. So the $100 profit wouldn't be with you. You would be only having $500 profit with you. The 500 and the initial cost of $200. So that means the total net profit is $300. Hope it is clear to everyone. I'm just repeating the same statement that we have already talked about earlier. Any confusion, Prakhar, with this entire paragraph?
No, sir. It's clear now. It's very much
Clear,
clear
right?
now.
Yeah, so it would be confusing, as I said, like option is bit tricky in the initial few readings. So you require two reading for sure. If you do two readings, then you would be comfortable. 2 to 3 reading would make you comfortable, and in initial few reading it would be like what we are reading. It is like going round and round, and same thing is coming. It is a two-way thing. Put does differently, call does differently. So there are two things which will confuse you unless you have a couple of reading around it, and probably jot down those points where you find confusion, especially in the last class that we covered. If you have a clarity around what is long call, what is short call, what is long put, what is short put, right? If you understand these four words, then I can say with confidence that you would not be finding much of difficulty in understanding options market. It is only these words which puzzle you. If you have the understanding what is long call, what is short call, what is long put, what is short put, then more or less you would be able to understand what we are talking, right? So with this, I would say let's take a 15-minute break, 15-20 minute break, then we will resume with the rest of the example, and I'll share this PPT with you. You can read through these options examples and build your understanding around it. You need to have some understanding about options because options are always bit tricky, and there are questions in the interview often asked about asked around these strategies that we talk. They would not be in a maybe would not be would not be a question to explain the entire strategy, but to understand your fundamentals, like what you understand, how what is break even and all those terms that we discussed. A person might confuse you and ask you about options also. It may happen, right? So that's the reason here we are doing strategies also. Probably you will not be asked strategies straight away when you go for the interview, but you should have understanding so that you can be confident while you're responding to the questions related to option market, right? So let's have,
Sir,
yeah,
I would request you to share both the PPTs there. This one and other one where the all the Greek definitions are there.
yeah, it is the same one. I have the Greeks also in the same PPT. This is the only
Okay.
PPT where we have Greeks. So if you look at here, one second, just give me a second. So if you look here, we have got the Greeks, right? So this is the same in
Okay.
continuation with the Greeks, right?
Okay, sir.
So I'll share it with you guys so that you can read it through, probably because in the initial couple of reading you will find it a bit tricky, but don't worry about it. It is something, because you are, especially for the people who are doing it the first time, they're finding it a bit difficult. And I'm sure Sumit, Vishal, and Siddharth, these guys are finding it relatively easier because they have some understanding around options market. So, and Vivav and I guess they would be finding it easier. So don't worry about it. So you will find this PPT and you need to read it out a couple of times. You will be okay with this. So let us have 15-minute break now. Okay, so everyone there?
Yes, sir.
Okay, fine. So we'll start where we left. One second. Call spread is done. Bull call spread. Now let's come to another strategy that we have in options world. That is long straddle. What is long straddle? Long straddle is also known as buy straddle or simply straddle is a neutral strategy in option trading that involves the simultaneous buying of call and put of the same underlying stock striking price and expiration date. So what is a long straddle strategy? So this is very common in the option world, because when you look at the option world, most of the people, uh, majority of the people, I would say, do buying of options. There are few, not few, I would say, there are many people who also go into writing and selling of option, but majority of the population go for buying of option, and they prefer this one because it is one giving benefit from two directions, from the upside movement and from the downside movement, both way. So, and most of the people don't have uh, a good clarity around the share market. When I say most of the people, I'm basically talking about people who rely on their broker and probably not doing a greater analysis and greater study of those positions which they are creating at their level. So from that point of view, I'm telling you this thing. And buying doesn't require more cost. However, on the other side, selling does require a lot of cost. When I say lot of cost, that means margin, right? Margin is the amount which is taken from the seller's point of view. However, from the buyer's point of view, it is just the premium which the buyer is paying in the first go. That is what is needed, nothing more, nothing less, right? So that way, we have a lot of buyers in the option market who happen to take position in this sort of strategy. So what this strategy is all about? So long straddle means you do buy one ATM call and one ATM put. So what does it mean? It basically means you are sure about market moving one direction up or the other direction, but you are not sure which direction the market is going to move, and that is why you are making this strategy. So you can clearly see when one person is buying one ATM call, at the same time you are also buying one ATM put. So what does it actually tell? It tells one is not sure how the market is going to move. So how come this happen? When can this happen? Any clue before we actually talk about an example when all these things happen? When this is more profitable, when one should actually go for this kind of strategy? Any thoughts, any idea? Just look at from your point of view. Maybe you need to make a strategy that is a long straddle, right? When would you like to make this strategy, sort this kind of strategy? Would you like to go for this kind of strategy, or would you not like to go? I hope I'm audible to everyone.
Yes, sir. Yes, sir.
Okay, okay, fine. So, like as an investor, if I am the investor, right, I would like to make a position in call, and so buy one call, buy one put. So that means I have got two views for the same stock, or maybe for Nifty also, because options can also be tried on index, right? With Nifty and Nifty Bank and also. Okay, okay. Right, okay. Right. Yeah, any thought, Harshit?
So we opt this kind of strategy when we think there are the 50-50 chances of the same stock. It might be go up, or in the same way it might be go down also.
Hmm. Right, you're right. So when so these situations happen, right? These situations actually happen. A stock which is trading pretty good, pretty normal in a normal situation, and maybe one fine day or maybe in one particular situation, it can behave in either negatively or positively. So, so you know what all situation I'm talking about. So maybe let's assume the same situation that we are into right now. We are into COVID situation, right? And there is a company like ICC Bank for that matter, and the bank is going to announce its results, right? So that's a news, right? So this news can either be positive, this can be negative also. So it is just not limited to just one particular example. It can be limited to any. It can be for a news only, where event, or we can term it event, when there is an event going to happen, and that event is either good or bad for a particular stock. That is when this is going to work, right? So there is an event, and that event is either good or bad. If it is good, then your buy ATM call will help you. If it is bad, then your buy ATM put will help you. So both ways, that event will lead you, but there should be some event. If there is no event happening, there is no bad and good news is happening, then probably this strategy, if it is just a normal situation, then you are going to make losses, because we know you are not selling here anything, you're just going to buy both the. So buying involves premium, so that means you are paying premium to the writer, and for both the options you're going to pay premium, and therefore you're going to incur uh, a good amount of money. And if there is no movement in the stock, then probably that money is gone, and you're left with nothing at the end of the expiry. So that's the whole story. Okay, let's look at this example now. Let's read it through. XYZ stock is trading at $40 in June, and option trader enters long straddle buys along July 40. So July 40, that means strike is 40, right? When I say July 40, hope now everyone is clear. If you're not clear, do let me know. If there's certain terms which you're not clear with, then uh, because your understanding is important. If you have understanding, then you would be able to understand the entire explanation. If the terms are not understandable, probably you will not be able to relate what we're talking. Then July 40 call for $200. $200, yeah. The debit enter net debit taken to enter the trade is $400, which is also the maximum possible loss. If XYZ stock is trading at $50 on expiration in July, the July 40 put will expire worthless, and July 40 call will expire in the money and has an intrinsic value of $1,000. Subtracting the initial debit of $400, the long straddle trader's profit comes to 600. On expiration in July, if XYZ stock is trading at $40, both the July 40 put and July 40 call expire worthless, and long straddle trader suffers a maximum loss which is equal to debit of 400 taken to enter the trade. Clear? Anything not clear?
No, it's clear. It's clear.
It's very clear, right? It's very clear, straightforward
So
strategy. So, yeah, Siddharth.
like in real life scenario, these such thing happens. Like people go ahead
Yes, actually.
sam.
Yeah, yeah. These are the scenarios where traders who are very regular with trading, they actually make such positions. So like assume I am the one who has some information about a company, right? Or there are investors who regularly track the market and track companies, how the company is doing, bad, good, and all that. And there is some information which is available in the market, in the financial market. This is that information people like to leverage the leverage the information and accordingly make position in the options market and make profit. And it is a real life scenario. These all strategies are actually made. The strategies that we are talking here, these are the one which are actually made by people, and this is one which is very common. The long straddle which I'm talking is very common one, because when you talk about the option world is more about buying trade than selling. There are very few people. Why I'm saying very few people? It is not people don't like selling. People like selling, like you also like, I also like, but selling requires margin, right? And everyone does not have margin, right? Everyone doesn't have margin, so that's a constraint which doesn't allow people to go for selling option. So buy is cheaper, buying is cheaper, where you do not require any margin. You just need to pay the premium that goes to the seller. And therefore there are people who know if there is an event or there is a news which is going to come, then they are definitely going to make some profit out of such study, this sort of a strategy. And if one way the market will swing, and the premium paid out will definitely be compensated with the profit made out on the trade, in one of the trades. So one of the trade will be profitable, one would be lost, right? So
Actually,
that is the reason.
this long strategy is works when market is in rally.
Yeah.
Maybe either way, maybe on higher side, maybe on downward side.
Hmm.
Uh,
Right.
it works on that position. But when market is slow moving or not moving much, this strategy
Yeah.
falls.
Right. Yeah, so if it is constant neutral, then it is going to be complete loss for the buyers, because you've taken two options. One is the uh, two ATM call option, and ATM is the costlier one, right? When you are at the money and you're going to take a position, so these are the costlier options. The option, in a sense, you would be shelling out more money to take position in these two options, be it investors who actually make this strategy with a reason, and there are investors who make it because they hope that there would be some profit out of it, right? Everyone is not doing that level of study, that great deal of the great detailed analysis and all that thing, but the various investors have various approach to the market. So but mostly the investors who do a fair amount of study about the market, they tend to take position in long straddle with the hope it will turn out to be a good trade at the end, right? So these are the real life examples that we are talking actually. Okay, so this is how the payoff diagram would look like. If you look at the when would be your when you would be making profit, when would be your break even.
40.
Okay, 40. Okay, what would be the break even? Break even. Sorry. Yeah, Harshit, you said 40? Do you want me to take you on the example?
Yes, sir. Yes, sir.
Yeah, now look at this example. It's very easy. And what would be the highest profit? One is the break even. Another thing is what can be profit and what maximum profit I'm saying. And the last thing is maximum loss that can happen. One is break even, maximum loss, and maximum profit. Three things I'm checking on this example.
Sir, break even is either it is $44 or $36, and
Mm,
maximum loss can be $400,
mm,
and maximum
right,
profit will be unlimited.
right. So he's correct. He's absolutely correct. So everyone clear like how we are saying break even is 44 and 36, because you can see if you look at this trade, the position that you have taken, you one position in the call, one position in put, one position in call, and for both the position you invested $200 each, so total $400. So that means in order to have it a break even, so you need to have a position wherein you can compensate the $400 investment. So that you can compensate only when the market either goes up till 44 or goes down up till 36. If it just stands at 40, then it doesn't make any sense to you. It doesn't make any sense to you, right? It can only make sense to you when it either go it would make sense to it. It doesn't mean it wouldn't make any sense if it moves to 38, it would make, but it would not be profit. It would not be covering your entire loss, right? It would not be. If it is at 38, would it make sense to you? It would make sense. It is not going to make sense, but it is not covering your whole loss or whole investment that you have put in into the strategy. So you have put in a $200 each side, one call, one put, so total is 400. So to cover your 400, if you are able to have a stock position either at 36, if you look at a downside, or at 44 at the upside, only then you would be able to cover your loss, or have. So break even is 36 and 44. And what is the maximum loss? You have only seen 400 is the maximum loss. Why? Because you have only paid premium, so that whatever premium paid, that could be the maximum loss, nothing more, nothing less, right? And then what should be your profit level? Profit can be anything, right? So if it goes like anything to any level, like it is going up and up and up, if you look at this payoff diagram, it is going up and up, up and up. And if it just goes up and up, it can go to any level, right? It can, if I draw from here to here, so that means whatever comes at this level, so 50 is here, 60 here, 70 is here, 80 here. If it is 80, that means difference of 40, right? 40 into the 100 shares, that means for 40 into 100, that means 4,000, right? $4,000. So that could be the profit. So it depends how far stock goes. Similarly, at a downside, the maximum profit could be of 40 to 0. It can go to max to max, it could be 0, right? A share value can be 0, but which is sort of making as an this is a technical point, not practically it can't be 0, right? Share can be 0 only when company is no more in its business, then only it can be 0. Otherwise share value, it will hold some value. So that's how the long straddle look like. Everyone clear, I hope. Short straddle. Short straddle, sell straddle, or naked straddle sale is a neutral option strategy that involves the simultaneous selling of a put and call of the same underlying stock, striking price and expiration date. So what here, it's the opposite of the long straddle. You can say
Sir,
it's
sir,
mhm.
here is the only difference is this uh, in short straddle there is a limited profit but unlimited loss.
Right. And here, the one thing we are talking about, the event, some news, right? Some event, the news is going to come, and that will cause a rally in the stock price, and that will cause a spike in the share price, right? So here, nothing of that sort is going to come. So assumption is, if you say neutral option strategy means you assume the market is going to behave as it is. So therefore, with this view, you take two sell, you sell two option. One is call, another is put, right? But you have got unlimited loss. You have got unlimited risk here if the neutral the neutral thought the neutral thought that you had while you sold this strategy did not turn out to be neutral in real life. Then it can turn out to be very negative for you as an investor, right? And in this strategy, if you look at this example, just read it through, you will understand. Now this example would be easier to understand because you're through with these couple of examples, so now shouldn't be difficult for you to understand. Yeah, where is that? Yeah, this is, just read it through and try to understand what we're talking here. Take 2 minutes and read it through, everyone.
Yes, done.
Hmm. Others done? Everyone? Avinav, how is it? Difficult, easy, understandable, need more time to understand?
It's understandable.
Understandable? Okay, good. Good. Ishika?
Yes, sir. I have some confusion, little bit.
Okay. Okay. So ask your questions. Don't worry about it because we are having online session. There are a couple of challenges, we know, right? But you need to come up with a question. You need to put it in the message box, or ask uh, mm, over the
So like,
microphone, whatever way you think. Yeah.
are we like, if we have any kind of doubt, can we have a separate doubt class for all such things? Like,
Yeah, we can. Why not? We can have a doubt session class, and but that would not be one to one, to be honest, because it would be for the whole batch.
yeah, it will be for the whole batch.
Yeah, we can have doubt session. That's not a problem. Even you can put a request to Karan or Damini also. We conduct doubt session classes also, and after every couple of classes, we can have like 4 5 classes. We can do a doubt session class also. That's not a problem. But like, maybe you're not able to fully ask your question because you not understand fully, right? That could
Yeah,
be,
exactly.
right. You don't have questions, maybe you don't understand it fully at this point in time. You might have more question when you read it 1 2 or 3 times, then probably you may have more question around it. So that's not a problem. You need not wait even for a doubt session class. You can ask even in other class also. We can take out some 15 20 minutes and try to cover on those doubts. If it is really lot of doubts, then probably we can have another session also, another class, dedicated class, wherein we can completely cover the doubts only. But if you have maybe just one or two doubts, then we can take it up in the same class where you we are doing a new chapter, and also we can touch upon the previous topics and the subjects that we did. That's not a problem. That's because it's all within us, right? We what we are doing in the classroom, because we know it's important to have clarity around what we are doing. So it is important, and I realize like this is important for everyone, because you are understanding from the point that you actually can implement on ground. These are the strategies. If you look at these option strategies, these are actually applied on ground. I also apply at times some of them.
Okay.
I use some of them. At times I make a naked position, but I cover. I don't keep it naked for the whole month, because then it is risky, right? You don't know. And at times what I do, I take a position for a couple of days. But I'm not suggesting here to start taking positions and making trading and all that. That's not the intent here. Here, the first thing is we need to understand how it works, and then only you would be able to make use of them, right? So you can maybe you can, once you clear with this session, just read it twice and understand how it actually works on ground. Look at maybe there's a dummy account also. You can open a dummy account. I'll check like which application is that. So the dummy account you can open up, and virtual money would be there. You can use virtual money. So instead of going for a regular money, you can use these strategies and see how it is working for you. Then you would have some interest, and that interest
Yes.
will lead you to discover more. Otherwise we don't discover more because we don't have interest, right? So that is how it can. Trading view paper has paper trading. He's saying Vishal knows like about some. What is Vishal this?
So TradingView is a platform where you can do paper trading, as
Okay,
in you are suggesting that you get a virtual money and you can trade there.
right, right. So this is good,
So
right? So because you don't, yeah.
we can make
So
a free
that way
account
you
in
can.
TradingView
Hmm.
and do the
Great.
trading. And as well, sir, instead of
What's
paper
the
trading,
Yeah.
sorry,
what's the name of that application?
TradingView, TradingView.
Sure. Okay. Okay. Thank you.
This is good in a sense, like you can get some hands-on experience, which would not be on the real, not on the real market, but it is a kind of a market, right? The stock price and everything would be the market driven only. The only thing is the money that you would be using, that would be the paper, not the actual money. It would be the virtual money. So it would not be, you would be losing and winning as per the trade that you do, but it would not be the actual loss. The actual money would not be going, right? This is a virtual money that would be that it would be shown that you lost on one particular trade or you won on the trade, or as in profit and loss and all that thing, but it would be in the virtual sense. Okay, so let's move on. So long straddle example, what we are doing here, anyone would like to explain?
So in the short straddle, like
Yeah.
if a person knows that in this particular the thing,
Yeah.
if the maximum profit is like $400 and the loss is unlimited, why will they enter
Hmm.
such trade?
Okay, so in a technical sense, we say it's unlimited. But to be honest, when you take a position, right, you can see your loss and profit. You can
Mm-hmm.
see your loss and profit, and you know the $400 which you receive in the form of a premium, that is fixed. That you going to receive no matter what happens the next day. So it's a human tendency. We like to have a fixed amount as a profit. It's a human tendency, right? So you believe how a stock would move. Like if we talk about TCS, I analyze TCS for a month or two, right? And I see how a movement is, how TCS does a movement on a daily basis, right? Or
Okay.
maybe on an average, how is the average trend of TCS? That's the average I'm saying, right? One fine day something bad happen, market swings, stock swings, this happen in the market, and that's the reason we say market is volatile. We say share market is not always fairy tale. It's not a fairy tale wherein people say like you can really make money, right? It is plus and negatives both. So the important thing is, when I as an investor, you as an investor, when take a position, probably I like to analyze one share for a couple
Yes.
of months and would like to see the movement for a particular share, how that particular share is moving in a given month, and with that I can form some assumptions or some ideas around a share. It moves this to this range. So if I sit at this level, if this particular level, I'll be receiving this premium, right? And if I
Yes.
receive premium, it would not be moving to that level. So here in this is the situation. This particular strategy is very different. But here the opinion of the investor trader is it would not be moving huge, as in it would not be giving a huge swing so that a person can lose the $400. That is the whole intent. But that is true. If it moves to the upward direction, there could be a loss of more than $400 as well. But I'll tell you the real life situation. Look at this situation from the point of view of a investor wherein you have taken two positions, one sell, one buy. This is what you've done here. You have taken, give me a second. You've taken one sell ATM call, one ATM put, right? In an ideal situation, stock will either go down or will go up. This is the two situation that we have, right? Agreed, everyone? This can happen. Either it can go up, it can go down. And I assume the stock doesn't move rapidly at one go. Then as if that happens, the time it covers, it reaches at the 400 loss, I square off my positions. What I'm doing here, I've taken these two sell positions, right? Maybe the stock actually moves to one direction, that is the upward direction, and it is about to cross the $400 profit which I have made, right? So when I say $400, so basically what I'm doing, I assume I have bought this call, the put, for $200, right? That means 2 rupees, 2 rupees per share, right? 100 shares we are assuming in this example, 100 shares, it's constant. 2 rupees is the put and 2 rupees is for the call. Not rupees, $2. Let's make it dollar, whatever you want to say. So $2 is your call, $2 is your put. So that means let's assume if it goes to, the stock goes to 42, right? Stock goes to 42 or 41. I still have an option to square off my position and be out from a trade, because in a real life situation it is not the one has to just hold off, one has to hold off to a particular trade until the expiry. People actually leave trade before the actual expiry. The only traders who are very sure about the position, they actually hold off to make the complete profit. Otherwise there are investors who can actually move when they realize this is not going to work, and that is the reason it helps uh, to the option investors. I'll tell you, maybe I'll show you the live also when I take a position. I have already made couple of positions in the options, so maybe I'll show you some position. So if the XYZ stock rallies in trading in 50 on the expiration in July, the July 40 put will expire worthless, but July 40 call expires in the money, right? And has intrinsic value of $1,000. Subtracting the initial credit of 400, the short trader's loss comes to 600. On expiration in July, if XYZ stock is trading at 40, both July put and July call expire worthless in the short trader gets to keep the entire initial credit of $400 taken to enter the credit. Clear? Any doubt here?
No, sir.
Right. So what is happening? 500. If it reaches to 50, then you as an investor is going to suffer loss, and that loss would be 1000 would be the intrinsic value of the call option that you sold, and 1000 plus the profit that you made, 400 as in the form of premium, $400. So that means the net loss would be $600 at the end of the contract, or the end of the maturity. Similarly, for another condition that we have, if it doesn't move, it stays at 40, then you have $400 in your pocket, because both the option will expire worthless. Neither the call nor the put would have any intrinsic value, and you would be keeping $400. Okay, let's now move on. So this would be your payoff diagram. What does it tell? What is the maximum profit?
$400.
Okay, and what's the maximum loss?
Unlimited.
Clear? So you can see, like, the maximum profit is this, which is this point, is your maximum profit. That's the 400 you can see here, and loss is unlimited. It can go to any direction. This is the downward direction. Like, profit and loss is this particular axis, right? This is your horizontal axis. This is a vertical axis, right? So vertical axis, you can see 0, 400, whatever. You can say this is going up, profit, and this is loss. So if the arrow is going down, that means you are going to incur loss. So in the situation, if you see both the arrows are going down, this arrow is also going down, this arrow is also going down, and it stops here. So this is the point where it is meeting. So this is the only profit that you're making. Clear, everyone? Long strangle. What is long strangle? Long strangle, also known as buy strangle or simply strangle, is a neutral strategy in options trading that involves the simultaneous buying or slightly out of money put and out of money call of the same underlying stock expiration. Right. So this is also one of the neutral strategy. The long option strangle is an unlimited profit, unlimited risk, limited risk strategy that is taken when the option trader thinks that the underlying stock will experience significant volatility in the near term. Long strangles are debit spreads as net debit is taken. Okay. So this is long strangle, wherein the hope is the market is going to move up or down. That is the reason you're buying out of the money call and put. Right. So there is going to be a significant volatility in the market, and stock is going to experience that volatility for sure, and therefore you're making this position. This is called long strangle, wherein the money involved is less. Why? Because you are buying out of call and out of put option, both sides. This is out of call and out of put. So whenever you buy an out of money option, they cost less compared to options which are at the money or in the money. In the money cost more, at the money cost less than out of money, than in the money, and out of money option cost, they cost as in the least compared to the two. Okay, so let's look at this example again. Just try to understand it. 2 minutes. what is happening here, then we have couple of more examples of short strangle strip is there, trap is there, synthetic closed. Okay.
Sir, I read it.
Done. Okay,
Yes.
so everyone, so what we are doing here, what is happening? Anyone want to explain?
Sir, I can answer.
Oh, okay. Other than you, Sudiksha, doubt, clear, not clear, maybe yes, yes, no, maybe whatever. Harshit, okay. Okay, so what I can do probably, guys, so we can quickly run it through, right? And I can share this PPT. You need to probably read it through because what I can sense, uh, many of you, barring few people, are not comfortable with this option. This is what I can sense. So the important thing is we need to be through with the option uh, slide, the first option slide that we have done, because the only reason we are not comfortable with these examples is because we are not through with the option, the presentation. Maybe you can just take another view or another reading of the derivative options class presentation that we had. And if you don't have, as in if you have questions or doubts around the same class, then you need to ask or clear those doubts. Then you would be comfortable, because otherwise this is not going to make any meaning to you for sure. Because option strategy we can only talk and discuss when you are clear with your basics, right? and therefore I can see the responses are less. There are less responses because you are not clear with basics. Only few are aware about the basics, and others are not.
So can I answer for this particular question?
Yeah, sure. Go ahead. Yeah.
Sir, we can have unlimited profit in this long strangle, and we
Mm.
have a limited loss. It will be around it will be $200, and break even will be either it is 42 or 40 or $38.
Mm. Right. Right. Correct. So your long triangle, this is how it would be formed if you look at. So what we are doing, suppose XYZ stock is trading at 40 in June, an option trader executes a long triangle by buying a July 35 put option for $100, right? And July 45 call option for $100 again. So that means $1 for each call option that you are you are putting investing $1 for each call and put option. Net debit taken to enter the trade is $200, which is also the maximum possible loss. If XYZ stock rallies and is trading at 50 on the expiration in July, the July 35 put option will expire worthless, right? And the July 45 call option expires in the money and has an intrinsic value of $500, correct? Subtracting the initial debit of $200, the option trader's profit comes at $300. The expiration July, if XYZ is still trading at $40, both July 35 and 45 July call and put option expire worthless. The options trader suffers a maximum loss of 200, which is the uh, initial premium payment which he made. Right, so that is how it is looking like. If you look at here, so the maximum profit, you can see what are the maximum profit. It's going up, the arrow, it is going up, it is going up, right? So the maximum profit can be this,
Unlimited.
unlimited, right? And your break even, you know what a break even?
No profit, no loss. Okay.
Yeah, no, oh, yeah, that is fine. What is the point? What would be the break even point?
So it's between 30 and 35. I think in 32
30 and 35, okay, okay.
and 45 to 50, between 40 to
50, 50. 45 to 50, as in 48.
because the line just held between them. So
No, don't go by the line. Maybe there is some. Just don't completely go with the line. Just look at from the understanding that you have. Look at from the understanding, because this there is some points are not correctly marked there with the diagram. I can see clearly. Yeah, tell me. 30 to 35. What is the 30 to you? Yeah, break even. Yeah, yeah. Ishika, what you said? 35, right? 35.
between 30 to 35.
Yeah. between 30 to
Because
35.
35
Okay.
will be the price, so the break at least at 35 it comes in the break even point, no profit, no loss.
Hmm. Okay. Okay. So the break even is your, yeah, which is right, because you are saying break even would be with me within 30 to 35. But can we also not find an exact number? Can we find an exact number? What would be the break even? And there would be two break even, right? There can be two break even in this particular strategy that we are making, right or wrong?
Yes, sir, there are two.
There are two, right? Because you can see two arrows, right? As in two points which are cutting here on this line. Break even means zero, zero profit. Where is zero? This is zero, right?
Yeah.
So wherever this line is touching on this horizontal line which has zero, so that point is called break even. But I'm saying don't be confused, because it is closing to 30, so that means that would be the point. So that there it has got a slight difference. So the break even is, what is the total cost you have paid for this strategy? 200, right, everyone?
Yes, sir.
So
Yes.
that means the break even can be either 35, 33, right? Can be either 33 or 47, right or wrong?
It also depends upon the buffer we give, na, because we're taking 33 and we have invested 35.
No, no, you're not invested 35. 35 is the
No,
strike.
we're taking 35, the 35 calls for $100.
I am not getting. What question you said? $100?
I'm saying that in the previous question, means the reference to this diagram, the question is, I think, for 35, I think I think call 35 call there is $100, and for 45
Okay,
put
no, that is because it is one assumption is made from the beginning when we took the first example. There are 100 shares, right? The lot that we are talking here, this lot has got 100 shares. So this lot has got 100 shares. So when you bought a call and a put both ways, the July put you bought for $100, okay, and July call you bought for 45. July 45 call you bought at for rupees 100. Similarly for put also, July 35 put you bought for $100. So that means $1 each, right? Because one lot has got how many shares? 100 shares. That assumption is from the beginning. In the beginning only we specified there are 100 shares. So that is not mentioned every time here in the example, but that is continuing, because we are assuming one lot has got 100 shares in these examples that we are covering. So that means $1 for each call and put. So total of $200 that you spent in buying these two options. So if there is a movement of 2 point either side, that will cover $200 or not, right or wrong? Either side $2 movement will cover your loss, will cover your $200. Break even means zero, no profit, no loss. Getting my point or not clear? Still not clear?
I think you mean to say that the one loss is the another profit is covering another loss. The one
Yes,
profit
yes.
is covering.
Yes, yes, right. So if there is a $2 movement, 2 point movement, when I say 2 point means $2 movement actually is taking place. 35 is your strike for put. Put strike is 35. So if it becomes 33, put is basically you have a right to buy. So right to buy, you would like to buy at a you would be able to buy at 35, right? You have a right to buy. No, no, sorry, right to sell. Put has a right to sell, not right to buy. Call has a right to buy. So you have a right to sell at what strike? 35, right? So when the price moves to 33, so you are in $2 profit. You will buy from market at 33 and sell it at 35. So that $2 multiply 100 shares becomes $200, and $200 is your initial investment. So the break even from the from one second from this point of view would be 33, and break even from this point of view would be 47. Clear? Okay, so we done this long. Okay, now coming to short strangle. Short strangle is where one is actually selling out of money call and out of money put. So the idea is one doesn't believe there is going to be a huge volatility. The investor who is doing this, making this strategy, is of the view there would not be huge volatility in market, and therefore he's selling one out of call and one out of put option, and the premium which he's getting which he's getting out of these two option selling is the maximum profit which an investor can have. So if you look at this example, suppose XYZ stock is trading at $40 in June, and option trader executes a short strangle by selling a July 35 put option for $100, right? So 200, one put option, one call option, he sold for 100 each. Maximum profit which he got is 200. This is the maximum profit. So if there is a movement beyond 35 in case of put and above 45 in case of call, then the trader is going to experience losses, right? So in this case the break even would be short strangle. In this case the break even would be
I think 37 and 42.
37 and 40. Okay, so your mhm. Anyone else? Sumit, in case of short strangle, what should be the break even? In this particular example which is given, what should be the break even?
Sir, I earlier told that break even will would be $42 or
Uh,
the $38.
30,
38 or 42.
38. No, 38 would not be. 42 is right. One is okay.
Just
42 I'm comfortable. 38 I'm not comfortable. Or in this case also the break even would be same. Short strangle. In case of long strangle, here this one and here this one, the break even would be same. Short strangle would be like this. Break even is same. So that means I've already told break even in the last example, that is 33 and 42. Here also the break even would be same. Okay.
I have a different opinion.
Yes, sir. You are right. You are right. Yeah, we buy both the both the options. So 42 is right, and you are also right. 30 is not, because
Yeah.
at 38 call will be zero. Value of intrinsic value of the call on expiry is zero,
Uh, right.
and put will be 30, 39. It will be zero. So it will be 39.
39. Why? Why 39?
So
Because
39
you have
because or
no. You
at
confuse with
39.
the strike price, I guess. You are assuming
So
we
I have a
have taken a
different view.
strike. Okay, Vishal. Yeah, go ahead,
Yes.
Vishal.
So according to me, the break even in this example should be 37 and 43. The reason
37 and 43.
43. Yes.
Okay,
The reason,
okay.
the
Yeah,
reason
go ahead
being,
with.
if the if the stock price goes to 37, then we have a 2 point gain in the short position. So
Okay.
here in this example, we have seen we have taken a we have made a we have to made two positions by selling
Right.
by selling put option for
Hmm.
35 and by
35,
selling
yeah.
a for 45.
Okay.
In
Sir,
this,
sir,
Yeah.
sir, I will stand with my earlier view, which is 42 and 38. I will explain you later after Vishal. After Vishal.
Okay.
no,
Okay,
you
fine,
can go
fine.
on with. I'll explain later. You can go on. You can go on. I'll explain later.
Okay, whoever, any one of you.
Sumit, are you
Yeah,
explaining
so
or
Sir, my answer is 38 and 42. 42, you are okay, na?
42 I'm okay. 35,
Yeah.
38 I'm not okay. Yeah.
Okay. 38. Second one is 38 because at 38, the interesting value of the call option would be zero. Okay.
Uh-huh. Okay.
Is it okay, na?
Yeah, right.
Yeah. And interesting value of the put option would be rupees 2
Mm,
at 38.
at 38, okay.
Yeah.
No.
So that means, so interesting value.
So no. So when you say the intrinsic value put will be 2 rupees, you're saying, right? At
No, no,
38.
no, 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 sir. Just a minute. Just a minute. Just a minute.
Yeah.
Okay, Vishal, you can go. Just a minute.
so? I'll take an example. I'll
Okay.
take from the very beginning. I'll like to explain it from the very beginning.
Okay.
If we considering if we buy a put call
Right.
in that scenario, if the stock price goes
Hmm.
up, then we
Hmm.
incur loss.
Okay. Right.
If the stock price goes down, then we
Hmm.
have gain. Then we
Hmm.
make
Hmm.
gain, right?
Correct.
And similarly,
Right.
when we sell a put call
Hmm.
and the stock price goes up,
Hmm.
then we make
Right.
gain. Then we make gains. And
Okay.
if the stock price goes down, then we incur loss.
Correct.
So in this case, we have short a position of we have short a put position of 35 for $100.
Hmm. Right.
If the stock price goes to 37, we
Yeah.
make a gain. We make a gain of $2, 2 points,
Okay.
which gets to break even, which will give us $200 profit if the other position goes to zero.
Uh-huh.
So am I
Okay.
clear till now?
No, the put one is not clear because if I just maybe let me just put it that way. Like you are a seller, right? You sold a put at a strike of
Yes,
35, right?
yes, sir.
So you expect this stock which is trading at 40, whatever it is trading at. I'm not pointing the current situation. 40, right? 40 is given there. Stock is trading at 40, right?
True.
And you have made this assumption the stock would not go beyond, would not go below 35, and you have
Yes.
sold it. You have made a profit of 100 as a premium, and this is the assumption that you're keeping in your mind. It shouldn't go below 35. So as long as it is within the range of 40 and 35, or even at 35, then also you're okay. You don't, you have nothing to lose, because you have given an option of 35. So that means only when it goes below 35, that means 34, then you are incurring loss.
Yes.
So
Right.
right, so when it is 33, so that means you will lose your 2 point, so that becomes
Right.
your $200. So that is how I'm saying
Okay.
your
Okay.
break
I
even
get.
should be
I get.
33 and 42. I hope I'm making sense.
Yes, sir. Yes, sir, I get it.
Okay, fine. So guys, here I'll stop because we are already overrunning, right? So what I can do, I can share this, because these examples are very same. It would not, you would not find them difficult, because now you're quite clear. And I am more concerned about people who are speaking less, right? And I want them to speak more, right? Harshit spoke, but not to large extent. Prakhar spoke, but we want people to have a same level of interaction, right? I want everyone to interact equally, to talk more, because this is your class. This is not something which I should be talking more, you should be talking more, right? So I know, like, some of you are comfortable, and some of you are not comfortable. I can very easily sense it, right? It is not I can't sense it, but I want everyone to be comfortable. I don't want only 4 people or 5 people or few people to be comfortable, the rest are not comfortable, because the idea of having a class is that everyone should be at par. That is the idea of having a class, right? So what I'm going to do, I'm going to share this PPT in group, right? And I want everyone to go through these examples, and tomorrow, not tomorrow, rather I'll give you a week's time. So read it in this entire week, understand these examples. Any doubt, let's clear those doubt in next week in class, when we would be having a classroom session. Hope it makes sense, everyone,
Yes, sir.
because it is extremely important. We should be clear with the things. It is not difficult, it is just we need to probably the basics of options, we, because we just need to focus a bit more there, and you would be clear for sure, I can guarantee you. So that's it from my end. Any more questions, anyone, before we close
Sir,
it? Yeah.
sir,
Yeah, Sumit.
I'm audible?
Yeah,
Yes,
you're audible.
sir. Sir, my attendance is I was not there starting 10 minutes.
No, your
So I
attendance
think
is,
my
I've not
attendance.
taken. I'm going to take attendance now. Probably I did not capture it, but I'll take it right now. Give me a second. Okay, give me a second.
Sir, what will be the timing for the tomorrow's class?
It would be same timing, 12 to 4 only.
12. Okay. And
Yeah,
online,
12 to
na?
4. Yeah, it would be online. This
And
weekend it would be online, and from
okay.
next weekend onward we would be doing the classroom. Okay. So let me just quickly take your attendance. Utmash is not there. Abhinav was there. Abhinav left early, right?
Yes, sir. I'm present.
Okay, so he's there. Anurag is not there. Anurag was there, but he left, so I cannot mark it, because you should be giving a reason why you're leaving. Apur is there. Apur is not there. Okay. And Bhavya left, I guess. Just he is having some issue with the Wi-Fi, so I will mark his. Harshit is there. Ishika is there. Mayank is there, right? Prakhar is there. Siddharth is there. Sumit is there. Suraj is not there. Vishal is there. Vishal, you were not there in the last. Oh, okay, you were having some. Suraj was not there.
No, sir, I wasn't present. I met an accident last time.
Okay, no worries. Prakhar, you were not there, right, in the last class? Anurag was not there. Okay, guys. So
Sir, I was there. Last class I was there.
Okay.
Hello?
Okay, fine,
Sir,
Prakhar.
I
So
was
I've
there in
taken
last
you.
class.
Okay, fine. No worries. I marked it. Okay, guys. So tomorrow we'll meet at the same time, 12, right? Till then, take care. Bye. See you again. Bye bye.